Great. So welcome everyone who's here in the room and to those of you online as well. I'm Mubin Haq. I'm the Chief Executive of a Financial Fairness Trust, and we're running this conference in partnership with the Resolution Foundation. So just a few introductory remarks from me. A little bit about the Financial Fairness Trust first. So we're an independent charitable foundation funding a wide range of policy and research activities, covering a number of issues from social security to pensions to taxation. And our focus is on improving the living standards of those on low to middle incomes. So very similar, in fact, to the mission of the Resolution Foundation. Given this synergy, it's no surprise that one of the first grants we made was to the Resolution Foundation, and that's an ongoing partnership which we're very pleased with, and one of our largest initiatives to date. So this work has built up a large body of evidence on wealth and hundreds of charts, which is not surprising given its Resolution Foundation, but more importantly, policy solutions. So why wealth? Well, it provides the ability to weather financial shocks, the proverbial rainy day, though for many it feels it's constantly raining, especially during the recent cost of living crisis. Too many in our society have very little to fall back on, and that was very clear during the pandemic when the government had to intervene to protect incomes. And if you're out of work, how much wealth you have will be a big drive in what job you take up. Having few resources pushes you to take up any job, and that's often not good for the individual or for wider society. Skills, experience and talent can often be wasted. Wealth also has a significant impact on the cost of living. This is most directly seen in the cost of housing. Having a home will over time lead to lower housing costs, but increasingly this is out of the reach for many, and too few are able to access social housing. We know many in the private rented sector are spending at least a third of their income on rent. Wealth, as we'll later hear, is also critical for when we retire. Pensioner poverty has reduced and auto-enrolment has been a huge success. However, our research with Resolution has shown that 4 in 5 are paying into a defined contribution scheme are not saving enough to have a decent standard of living in retirement. In short, wealth is critical to the choices we make and the control we feel we have over our lives. And yet we've done too little to grow the assets of those who need it most. And too often the support and incentives we provide go to those who already have significant wealth. If I can take just one example from the work we've done with the Resolution Foundation, and that relates to ISAs. Our work here has shown that these are very poorly targeted and overwhelmingly benefit those who already are wealthy. Around a third of ISA wealth is held by the richest tenth of families, and the tax relief provided last year was £6.7 billion. Meanwhile, Help to Save, a scheme for those on universal credit, had cost the government £43 million when we reviewed it. That's a huge, stark difference as to where incentives and support are going. No wonder Resolution termed ISAs as ineffective savings accounts. Unlike income, we've seen a huge boom in wealth over the last 2 decades, and the wealth remains concentrated at the top. Taxation of assets hasn't kept pace with this growth, and yet we now face real difficult choices. And lots of you will be familiar with the conversations that's going on now with a Chancellor and a Prime Minister. And he's made clear that the broadest shoulders should bear the heavier burden. A number of the main taxes have already been ruled out, and a number of choices are to be made. Now, it's unlikely we will see some past taxes resurrected, whether or not that's taxes on wigs or taxes on hair powder for those wigs, clocks, watches, chimneys or windows. Those are unlikely to be there. But it's not just about raising taxes today. We also need to increase the assets of those with very little. We do need some levelling up. And this is of concern to Conservatives too. As Sajid Javid, that well-known Marxist radical, made clear in a collection of essays on wealth that we supported Bright Blue to undertake. He said, "We risk creating a generation that turns its back on the politicians who failed them. A generation that, without any capital of its own, becomes resentful of capitalism and capitalists." So today's event is about asking some of the big questions relating to wealth. What might happen to wealth over the coming decade? Will it continue to grow? How can we take the public with us on changes to taxation? Who needs to be paying more? And how can we increase wealth for those who need it most? And above all, thinking about some of the unintended consequences that there might be. So we have most of today to debate and answer those questions. We've got a great panel of speakers. So on that note, I will hand over to Mike Brewer, the Interim Chief Executive at Resolution.
Thank you. Thank you very much for that, Mubin, for those remarks and also for your foundation support. I think this is the 5th year we've been working on wealth things with you. Yeah, so that's been fantastic. And welcome then all of you in person and those online. This is our first Wealth Conference. The aim is to bring together academics, researchers and other people working in policy spheres to think about both what's driving wealth in the UK, but also what does that mean for policy. We've got you see, those of you in the room could see who's in the room. We've got a reasonably large audience for us in the room. We've also got people online. For those of you staying all day, that's fantastic. You're very welcome. For those of you dropping in and out, that's also fine as well. But as you see, the format for the day is 4 sessions with 4 amazing panels, not just one amazing panel. Shortly I'll kick us off with our first one. Just a couple of things on logistics for those of you who are here in person and staying all day. We'll have all of our coffee and lunch breaks upstairs on the ground floor. I'm told there will be access to the garden if you'd like fresh air, although I realise it's got a little bit autumnal today compared to what we've been having recently. The facilities are actually more of them on this floor than there are on the ground floor. So there are 3 toilets just outside on the left. There's only 1 on the ground floor. And if you could avoid bringing food and drinks into this room, that would be very much appreciated. For those of you, well, all those of you online and those of you here, if you want to ask questions, I would urge you to use Slido. The code is New Era. And as we are streaming this online and the video is able to be watched afterwards, everything that is being said is on the record. I think that's all I had by way of general introduction. So we'll kick off with this first session in particular. So the context for this is it's been 10 years since Piketty's groundbreaking work, Capital in the 21st Century, with his key argument that wealth inequality is likely to grow and grow and grow as the rate of return on wealth exceeds the rate of growth in the economy. I mean, whether that is right or not, his book had a profound impact on the way we think about wealth accumulation and the wealth inequality and the impact that has on society. So we'll take that as our starting point. The point of this session right now is to review where we are 10 years after that landmark report and what is the state of household wealth in the UK today. We'll have 3 speakers. First of all, Simon Pittaway, who's an economist at senior economist, at Resolution Foundation, will show us some more of those charts that we've been alluded to. And then in response, we have Professor Ben Mole from the LSE and Dr. Eleni, I'm so sorry, Eleni, in my excitement, I've forgotten your surname, Karagianaki, also from the LSE, who will respond. That's incredibly embarrassing. I've known Eleni for a number of years. And then we'll have time for Q&A. Simon, if you please start us off.
Great, thank you, Mike. And thanks everyone for coming today. So, make sure this works. Yeah, brilliant. All right. So today's conference is all about looking ahead to the UK's next decade, thinking about the role that wealth and savings will play, and setting out a policy agenda for the coming years. And later on, you'll hear from some brilliant speakers on the future of policy when it comes to households' financial resilience, pension saving, and wealth taxation. And we're bringing together these often distinct policy areas in the hope of identifying some of the links between them and looking at some of the potential overlaps and trade-offs when thinking about policy solutions. But first, before we look ahead, we need to look back and understand how the world of wealth in 2024 came to be. And conveniently for us, when we were coming up with the title of this session, 2024 marks 10 years since Thomas Piketty's Capital was first published in English. It was actually published in French in 2013. So in my presentation, I'm going to take that 10-year frame and highlight a few key things that we've learned about wealth in the UK over the past decade. And these are things that you should keep in mind during the rest of today's sessions. So to start, sorry. Okay. Forgive me for the bad slide management. So I'm going to start with something that hasn't changed in the past 10 years, and that's relative measures of UK wealth inequality. So here it's measured by the Gini coefficient of household wealth using data from the ONS's Wealth and Assets Survey. And as you can see, all these lines are basically flat, going back to just before the financial crisis and up to the eve of the pandemic. And we've also seen little change in the share of wealth concentrated at the top of the distribution. Here showing the top 1%, or the share of wealth owned by the top 1% and top 10% of richest households. And we have a longer time series for this, and we can see the kind of big picture, which is wealth inequality starting very high at the beginning of the 20th century, falling throughout most of the century, and then flatlining around the mid-1980s. If we look abroad, we can see the trend is a little different. Very sorry about this. Okay. Yes, we can see the trends are a bit different, especially in the US. There they saw a kind of gradual fall in the share of concentration of wealth at the top of the distribution throughout the mid-20th century. But as the UK's flatline, the US's line has kind of surged again from around the kind of 1970s, and they've opened up quite a big gap on this measure with the UK and also France and other countries in the G7. But thinking again about the past decade, even over that 10-year period, the US hasn't actually seen a kind of continued acceleration of increasing wealth inequality. And for some, the absence of increasing inequality may come as a surprise. And at face value, at least, it doesn't look like the, quote, endless inegalitarian spiral that Piketty mentioned back in 2014. And I think part of this surprise is because there exist some extremely wealthy people, often based in the US, people like Elon Musk, Jeff Bezos, and that informs our perceptions of inequality more broadly. But I also think it's fair to say that the UK and countries do feel increasingly dominated by the gaps between those with and without wealth. And one of the main reasons for this is that while the distribution and concentration of the UK's wealth stock hasn't changed much, the total size of that stock has. And this line shows you that. So up until the most recent round of the Wealth and Assets Survey, just before the pandemic, the post-Piketty decade saw the continuation of what is arguably the most important trend in the UK wealth landscape, namely the huge rise in the total value of household wealth relative to incomes. So back in the 1970s, the total stock of household wealth was worth around 3 times GDP, but that rose throughout the late 20th century to reach about 7 times GDP on the eve of the pandemic. And that rising value of wealth means that even without changes in the relative measures of wealth inequality, we've seen a widening in the absolute pounds and pence gaps between those at either end of the wealth distribution. And you can see that in the chart here, which shows the gap between the average wealth of families in the 5th decile of the distribution, so in the middle, and those at the various other deciles. So you can see the gap between the middle and the top, the kind of set of bars on the right-hand side, having increased quite significantly, despite the share of wealth owned by the top 10% not increasing much. In 2014, that gap between the middle and top was about £1.3 million in today's money, but had risen to about £1.5 million on the eve of the pandemic. To put that into context, that's about 44 times average earnings, which illustrates this really kind of sizable task of moving up the wealth distribution by saving out of one's own income. So that's the story up until the eve of the pandemic. Figuring out what's happened to wealth since then is a little tricky since we don't have the kind of comprehensive ONS data on household balance sheets for that period. But we can use a combination of aggregate data, partial survey data, and modelling to paint a picture. And I can give you a preview of some forthcoming work from the Resolution Foundation that does just this.
Drum roll.
Okay, brilliant. So this is the wealth to GDP line that I showed you earlier. And if we extrapolate that based on the aggregate amount of active saving since 2019, then what we see is a kind of modest tick up in the level of wealth relative to incomes. And that's actually, despite some really kind of historically high levels of saving, both during the pandemic and then actually through the cost of living crisis, we've seen savings rebound to a pretty healthy level in aggregate, although we know there's quite significant differences across the distribution. But we've also seen over the past 5 years some really big moves in asset prices. If you remember, on the rebound from the pandemic, we had a huge increase in house prices, and that's cooled off. We've also seen interest rates rise, the value of gilts, government debt falling quite a lot, various like equity booms, lots of big movements happening all at the same time. And these have actually been even more important for the total value of household wealth. So we've seen a big spike with the kind of book value of household wealth reaching about 8 times GDP just in about 2021, and then that kind of falling off quite rapidly as interest rates have risen and some of these asset prices have moderated. So, it's worth highlighting these estimates are uncertain, but the key takeaway is that asset price moves matter a lot for household wealth, and they're often driven by changes in interest rates rather than changes in the outlook for incomes in the future. So we can see that over the kind of long period, there's a big fall in real interest rates throughout the 20th century, and then a bounce back since the pandemic, and that's kind of mirroring what we've seen in the overall level of household wealth. So to summarise, 3 things that you should take away in terms of what's happened to wealth over the past 10 years. So contrary to what you might have thought after the publication of Capital 10 years ago, the past decade hasn't seen an increasing concentration of wealth or an increasing relative wealth inequality in the UK. But the size of the stock matters too, and that's been on a round trip in the past 10 years, but it does remain high historically. And asset prices, rather than movements in the saving rate, matter most for the total value of household wealth. And it looks like interest rates, rather than stronger income prospects, are the main underlying driver of those. The question that we're going to touch on in this panel and throughout the day is, what does all this mean for policy? But I will leave it there, and others on the panel will have very interesting views on this. Thanks.
Thank you, Simon. Great. Well, if you've got questions, save them up or go to Slido. The code is New Era and type them in there. But in the meantime, we'll have our 2 responses now. So first from Ben Mole.
Thank you. Thanks very much for putting together this event. Really great, and also thanks to the Resolution Foundation and the Financial Fairness Trust for being at the forefront of, putting together these important discussions and debates. So this session is very nice because it gave me a chance to reread Piketty, also, which I hadn't done in some while. It sort of brought back all these fond memories of back in 2014 when I was an assistant professor with lots of time on my hand. And I remember devouring this whole book, all the 450 pages in sort of a week or so, something like this, immediately when it came out. This actually had a big influence on my work. And I guess I'm actually one of the people who actually read that whole book. I think I remember that there were a lot of people. The joke at the time was it's a bit like Stephen Hawking's Brief History of Time, where everyone has that book on their bookshelves, but lots of people only read sort of the introduction. For me, it was actually important. I wanted to speak about something that sort of segues very nicely from Simon's slides. But that's actually something that does not get much attention in Piketty's book, but which is super important for wealth dynamics. empirically in the data, namely asset prices and capital gains. This comes in lots of debates. Always, I guess there's going to be a session on taxation later in the program. But if you've been following this a bit, for example, in the U.S. right now, there was a big debate on taxing unrealized capital gains. This was like the Biden-Harris administration, and Kamala Harris. At some point, it looked like that was going to be part of her economic plan. Then there's always these wealth taxation proposals. So Gabriel Zuckman, for example, has this proposal for a 2% minimum tax on global billionaires. And if you think about these kind of topics, a lot of the times it comes down to how you think about asset price movements. And I wanted to come back to that a bit. If you actually read Piketty instead, I checked this last night. In the 450 pages, asset prices are only mentioned like 23 times in all the 450 pages, or the word sort of valuation also only gets mentioned sort of 15 times. So not very much. And he has a very short section on asset prices. Sort of, I don't know if people remember this. There's this idea, what he calls the second fundamental law of capitalism, which is basically, for economists that know this is a version of the solo growth model. It's the idea that the capital income ratio in the long run tends to the ratio of the savings rate to the growth rate. And he sort of just has this brief section where he says, oh, that kind of ignores asset price changes. But I sort of think these sort of average out in the long run. You can kind of, not worry about those too much. Okay. But if you look at, the charts that kind of Simon showed, it shows kind of pretty clearly, I think, that that's not true. So that big increase in the aggregate wealth to income ratio from like 300% to 700%, a lot of that is asset prices, right? It's house prices going up, stock prices going up, and so on. And so in this context, I also just wanted to tell you a little bit about the academic finance literature, in particular because it, again, links to something that Simon says. And there's an important idea that Robert Shiller at Yale won an economics Nobel Prize for, actually. In particular, there's a very important paper from 1981. It's called, the title is, Do Stock Prices Move Too Much to be Justified by Changes in Dividends? Okay, so if you just look at stock price movements in the S&P 500 or something like this, and you look at the dividends that are paid out by these firms or the profits of these firms, the difference how you measure this, you can see, how much do the stock prices move and how much do the dividends and the profits move. And what you find always very consistently is that the stock price movements are way too big to be justified by movements in the actual payouts that you get when the cash flows generated by these assets. Okay, meaning that stock prices see huge swings, many of which have nothing to do with sort of the fundamental value of the assets, as in just the discounted value of the cash flows generated by these assets. Okay, the nerdy finance word for this is discount rate variation. Okay, so the idea is that you can think about this. It's sort of really unexplained variation, but you can think of this as the sort of effective discount rate that's applied to the cash flows moving around over time, and that's really what causes these asset price movements. But really, what it's just saying is we don't really know why asset prices move. Okay, and it's just they're just moving around for all sorts of complicated reasons that have nothing to do with cash flows. Okay, and it turns out this is very important for wealth inequality dynamics. If you look in the data, there's a very nice paper. So there's been a lot of work, I guess, exactly in the last 10 years on this, since sort of Piketty came out. There's a very nice paper by three economists called Moritz Kuhn, Moritz Schulrich, and Ulrike Steins. And they coined this idea of the race between the housing market and the stock market, and that mattering for wealth inequality. So there's the idea that if you look at something like the top 1% wealth share, that tends to go up whenever stock markets do better than housing markets, and it does worse, or it goes down whenever housing markets do better than stock markets, for the simple reason that the richest guys, the top 1%, have portfolios that are more skewed towards holding stocks than real estate, whereas sort of the upper middle class hold a lot of housing, so they tend to do better when housing markets do well. Okay, And you see exactly these kind of dynamics also, in these charts that that Simon showed, I guess. In this context, I also kind of wanted to link back to Piketty, and this is maybe again for people who remember this. He has actually a lot of very nice historical discussion about sort of wealth inequality and so on in maybe the 18th century. In particular, he has a lot of quotes from literature, so authors like Jane Austen. Okay, and the argument I think he makes very nicely is, at the time you don't really have data, but if you actually read those books, you can get a pretty insightful description of what life looked like in terms of wealth distribution and income distribution at the time of Jane Austen. And there's a sort of related very nice article that Paul Krugman wrote in the New York Times a few years ago, in which he speaks about wealth inequality dynamics, and also has an example from Jane Austen that I wanted to mention. So in particular, he says if you read sort of Pride and Prejudice, there's a lot of discussion of status and income, of course, right? It's always about who do these daughters marry, and how much are these gentlemen bringing to the table. But if you read this in detail, sort of it's always about what's their income stream per year. So the way Jane Austen talks about it, Mr. Bingley had £4,000 a year income. Mr. Darcy has sort of £10,000 a year income, so he's a better catch in a sense. And so the important or the interesting thing there, that's Krugman's point, is notice it's income is the thing that Jane Austen talks about, not the value of the estate of Mr. Darcy. Okay, it's the income that's generated here. And so, this kind of links back to the kind of charts that Simon showed, and Krugman has this nice thought experiment. Then he says, okay, now if you think about, I don't know, maybe interest rates fall, and because of that, land values go up. So, the Mr. Bingley's estate is now worth twice as much, or Mr. Darcy's estate is now worth twice as much. He says, well, they're still Mr. Bingley still only has £4,000 a year, and Mr. Darcy still only has £4,000 a year. So in a sense, it doesn't really change their annual income, and sort of as a result, sort of how good a catch they are here. And I think it's sometimes useful to keep that in mind. The real world is a bit more complicated. So this is a particular example of a very illiquid asset, right, that they're not going to sell. So what a lot of recent work, basically, including my own, argues is that basically what you need to look at is not the value of the assets, but whether people sell basically the assets or whether they're buying. So it's more about the transactions mattering rather than the value of the wealth. It becomes a bit more complicated. In particular, there's you can obviously do if you have appreciating assets, you can do things like borrow against the assets maybe. And sometimes that has tax advantages. But to a first approximation, really the main thing to look at is the income generated by the assets, or whether then you can cash in on a capital gain and sell. So I think I'm gonna just say one more thing there, and maybe we can discuss this more in the Q&A. There's some interesting implications for tax policy. I guess there's a session later on tax policy. I'm just going to throw out one thing there. From my point of view, there's always these ideas of or these proposals for like a wealth tax or a tax on unrealized capital gains, so where you would be taxed on appreciating assets even if you don't sell. In my view, those are not sensible proposals. Instead, it makes much more sense to have a system like we do now, where you tax realized capital gains, maybe at a higher rate. That I think is probably a sensible idea. There's one other thing that's kind of interesting also that I think needs to be discussed more, which is actually kind of a bit of a loophole in the UK. It's also there in the US, which is discussed a lot, which is what's called step up in basis at death in capital gains taxation. So I don't know if people are familiar with this. So the way it works, right, is if you bought an asset 30 years ago and it appreciates a lot, if you sell the asset 1 year before your one day before your death, you pay huge capital gains taxes on it. Okay? If you instead bequeath it to your child, and the child sells it 1 day after the death, you pay 0 capital gains tax on it, right? Because the basis on which the capital gains tax is calculated is stepped up at death. This is actually something that can be exploited a lot for tax optimization purposes. So in the U.S., people engage in this a lot. It's a strategy that it's then actually informally called buy, borrow, die. So you buy an asset, you hold that asset, you borrow massively against it by putting that asset up as collateral, and then when you pass away, you just leave the appreciated asset to your child and therefore completely avoid paying any capital gains taxes. Okay, that is, in my view, like a big loophole that should be fixed. Okay, it's actually also here in the UK. Somehow here it's not discussed very much. So this seems actually kind of a good, policy to do. I think I've seen some discussions of the new government maybe being interested in this, but nothing concrete. So this to me seems like a good thing to do. More extreme things like taxing wealth or unrealized capital gains, I would be a bit nervous about because of exactly the sort of Mr. Darcy logic. Okay, I'll stop there.
Thanks very much, Ben. We definitely missed a chance there to do a poll on who's read Piketty and who's read Pride and Prejudice. I've read both. That'll be okay. Yeah. Thank you. So we're continuing with our LSE double act responding. We have Dr. Eleni Karajanaki, who is at the Centre for Analysis of Social Exclusion at the LSE.
Thank you. Yes, thank you for having me here. And I think what I was planning to talk about would repeat quite a lot of what Simon said. So I'm going to try to condense the first part of my talk. I mean, we've seen that during the last 20, 30 years, wealth increased due to massively in the UK due to massive capital gains, mainly in housing wealth, with the underlying factor being rises in asset prices in housing and pension wealth, but with no active household savings being playing a minimal role. So we've seen also that during the pandemic there has been some changes in active savings, some increase in wealth due to active savings, which was increase the wealth of some households, mainly at the middle and upper part of the distribution. This active saving, of course, was driven by pandemic consumption constraints. And then during the cost of living crisis, we had a massive drop, a big drop in wealth as the peaked interest publication, as Simon showed here, and the peaked interest publication showed last year, which was mainly driven by large drops in pension wealth among which affected mainly households at the upper part of the upper part of the distribution, which again was driven mainly by the rise in interest rates having a negative effect on the valuation of pensions. So these dynamics in wealth provide lead support to the hypothesis that wealth, and yes, another thing that I would like to say during that, of what happened during the cost of living crisis was that despite this fall in wealth, which affected mainly the upper part of the distribution, we also seen large drops in wealth of low wealth households, which accumulated. My own analysis from Understanding Society showed that there has been a large increase in accumulation of debt and among low wealth households, and very high levels of over-indebtedness, not only in terms of high levels of unsecured debt, but also due to household facing problems with their household bills. So in another analysis that I undertook to examine over-indebtedness, I found that 13% of households in London are facing over-indebtedness problem, and 10% in the UK overall. And so we're coming to think that, okay, the overall, the patterns of change in wealth and how they moved relative to interest rates does not give support to the R minus G model. But at the same time, we've seen large increases in the absolute gaps in wealth. So the next thing that I would like to talk about is given the current forecast about the weak economic growth and the falling but higher than their pre-pandemic levels interest rates, what we can expect about the evolution of household wealth. Okay, there are two forces here. On the one hand, we can expect that possibly because the returns to assets, passive gains on pension and housing assets may be lower than their pre-pandemic levels. There may be some decrease in wealth. On the other hand, there may be some increase in active saving among households as interest rate rise, and so this would have an opposite effect, positive effect on wealth holdings, where the balance of these forces lies a matter of, I suppose, empirical observation in the future. But then what also matters here is how these opposing trends will translate into wealth inequality outcomes. So the question that arises, given these two opposing potential trends, is how we can ensure that household wealth changes in a way that have a desirable impact of both on wealth but also on the income distribution. We've seen simply because interest rate rises and remain higher than their pre-pandemic levels, it doesn't necessarily follow that poorer households or even households at the middle of the distribution would benefit from that and would be able to save more, and thus decreasing wealth inequality. So in order poorer households to benefit from higher interest rates, they should save more. And for that to happen, households have to be left with enough money after they paying their household bills, taxes, pension contributions, in order to save. To this end, there are both income policies that boost income of households are relevant, but also policies that, tax policies that would tax wealth would be appropriate. So there has been the argument that given the rate for a given rate of return on capital higher, rates of economic growth have an equalizing effect. To have an equalizing effect, growth we need growth-friendly tax structures. So taxing capital gains and inheritance tax, changes in inheritance tax would have, I suppose, a desirable effect. And with reforming capital gain tax, and I'm talking about, again, realized capital gains. Yeah, that's it from me. Thank you.
Thank you very much, Lee. Okay, there's absolutely tons to get. We could get stuck into from those two responses to Simon's talk. The role of interest rates in driving asset prices and wealth inequality. From Ben, Eleni's reminded us of the really important point to think about the distribution. Get your questions in on Slido, ideally. The code is New Era, or there is a roving microphone if you don't want to use technology. I just thought I might ask Simon to kick off, just building on what Eleni was talking about, the distributional aspect, and also remind us just how strange the last 4 years have been, both in terms of the amount of active saving. I mean, if you were in 2019 doing your forecast for the next 5 years, there's no way one would have predicted this much active saving going on. But so I wonder if you just expand on that, talk us through the pandemic and cost of living crisis, but also, in doing so, bring out the distributional points, which Eleni so rightly reminded us of.
Yeah, sure. So, the pandemic was a very weird time for lots of reasons, but in one specific way it was weird is what happened to the saving ratio in the UK. I think it peaked, depending on your precise measure, about 20-25%, which is like completely off the scale when we're talking about history. It's usually, on the kind of most comprehensive measure, it's about 10%. And that, as Eleni alluded to, was like a large part of that was people not being able to go out and make discretionary spending because lots of sectors were closed. And as a result of that, those savings accrued to the people for whom discretionary spending is a bigger part of their economic lives. So we ran some surveys throughout the pandemic and consistently saw that it was people towards the top and middle of the distribution who were able to increase their savings relative to their pre-COVID levels. But we did see at the bottom that wasn't the case at all. I think more people said they were able to save less or had seen their savings fall than had seen their savings rise for obvious reasons to do with reduced economic activity, was going into recession. So that was like a really big and quite transformative part of our savings life. And then we have the cost of living crisis, where if you looked at what the OBR was saying, what the Bank of England was saying, as inflation was starting to rise, the general narrative was the saving ratio was going to fall as people saved less, try and maintain kind of real terms consumption in the face of rising prices. People would kind of save less to smooth through this temporary shock. But actually we've seen the opposite, and savings have risen throughout the cost of living crisis to kind of reaching kind of if you look through the pandemic period, we're now at historically high rates of saving, which it was definitely a surprise. But when you think about some of the kind of traditional mechanisms of what higher interest rates do to the economy, people get more of a return on their savings. Interest rates redistribute income towards people like pensioners who have lots of savings to begin with and might want to save a bit more, and away from people who have big mortgages and might be kind of spending everything, all the free income that they have. So it's not surprising in that respect, but it did kind of catch a lot of people off guard. And again, that's had a distributional impact. We know that the cost of living crisis has been especially hard for lower income families because it's been concentrated in energy and then food. It's been the kind of real incomes have been squeezed the most at the bottom. So, it's people towards the middle and top who again made those savings. In terms of where that's left us, and obviously on top of this, there's a huge like constellation of asset price moves. Where it's left us, it's kind of hard to say. So we're still waiting on the next wave of the ONS Wealth and Asset Survey. So the latest wave we have from that was 2018 to 20. So we still don't have a kind of really comprehensive look at household balance sheets after the pandemic, not even after the cost of living crisis. There are different surveys. The Understanding Society survey is one. There's a few other household surveys where we can get a bit of a partial look, but they're a bit more difficult to see exactly what's happened. But I think directionally, it's definitely the case that these active savings have shown up more on the balance sheets of middle to higher income households. To the extent to which that has really changed things, I think will become clearer in time.
Thanks, Simon. I mean, there's no question that we know the cost of living crisis had distributional impacts. So we may not know the exact impact on balance sheets, but we know from what it's doing to arrears, what it's doing to problem debt, what it's doing to people going to citizen advice, what it's doing to food bank use. So there's no doubt it is having distributional impact. But yes, you're right. We lack high quality information on household balance sheets. There's a big lag. Go on, Simon.
Just something that Eleni mentioned as well is what we've seen during the cost of living crisis is increasing levels of people going into debt on priority household bills. So that's been the kind of the really kind of clear trend is utility bill debt, council tax debt, rent arrears really increasing. And part of that is in a world of higher interest rates, normal credit is more expensive. And we've seen, if you look at the Bank of England does a survey where they ask lenders how have your credit conditions changed. Throughout the cost of living crisis, they were consistently tighter and tighter and tighter. And so, people who are on low incomes are kind of really on the edge already of being approved for credit, finding themselves not able to get that, but the kind of underlying financial pressures haven't gone away. And so these kind of priority debts are becoming more common as a release valve.
Great, thanks. Ben, anything on the distributional point? No, okay,
no,
that's fine. We can move on. Great. Then the second topic I wanted to tackle was really, Ben, what you were talking about. The Mr. Bingley and Mr. Darcy example is a really good one. But yeah, the key point that much of household wealth is determined by asset prices, and asset prices are to a large extent determined by interest rates. And so, to what extent should we see, have people with wealth actually become better off when interest rates change? There was also a question for the audience which I didn't know the answer to myself, so I thought we might flash it up just to give Simon or Ben or Eleni a chance to see whether they know the answer, and if they don't, maybe Molly or James in the audience can start Googling it, but I think this question is getting at the same point. So it is definitely the case that you said, Ben, a great deal of that rise in household wealth from 300% of GDP 700% GDP was driven by capital gains. I can't remember exactly how much. I feel like it's like the overwhelming majority, and I can't remember exactly how much is due to house prices. But that's just we could address that question. But I think the more fundamental one is that argument you were making, Ben, that if interest rates change and you hold assets, you haven't actually become any better off. I wasn't sure whether you were advocating that or just saying that that is one case. So this comes up in our conversations, not so much about Mr. Darcy and Mr. Bingley, but it certainly comes up when we think about defined benefit pensions. So a great deal of the change in wealth inequality in the last few years has become because of the way we value people with defined benefit pensions, which give you a fixed stream of income when you retire. And so when interest rates fall, the value of that seems to rise, and vice versa. And it also comes up with house prices, where if house prices go up by 10%, you're still living in the same house, your flow of housing services hasn't really changed. So that's another argument for, in the case for, we should just perhaps, these are perhaps illusionary or not necessarily genuine changes in wealth. There's a counter case though, of course, which is that if house prices double, if they double relative to earnings, then it's now twice as hard to buy a house from your earnings as it used to be, and similarly for the pension example. So I think I think that debate is really crucial in deciding how we should think about some of the changes in wealth inequality. Ben, you're going first.
Yeah, absolutely. No, really important stuff. So the first, just wanted to clarify one thing about a lot of asset price variation is driven by interest rate changes, and that's the sort of asset price gains or capital gains that are different from the ones that are driven by cash flows. I just wanted to clarify that actually I think it's considerably more general than just asset price changes driven by interest rate changes. Again, this comes back to this Robert Schiller paper I was talking about. It's really, all asset price changes that don't necessarily come from like expected future cash flows of these assets. So, again, house prices, I mean, they don't just move because of interest rates, they also move because for some reason people like certain places better suddenly. Stock values of particular companies go up and down because of speculation and so on. All of those reasons, again, the finance people would lump together under the term discount rates, which is sort of that would also include interest rate changes, but it's sort of a more general thing that like there's all these reasons that asset prices move around that have nothing to do with the cash flows, and those are, generate these sort of illusory or paper gains to a certain extent. Second, just on the housing question there, just very briefly, I mean, that differs a lot according to which country you look at. I don't know the numbers for the UK, but yeah, I would imagine it's probably more than half of the aggregate increase in wealth to income ratios is housing prices. Pretty soon after Piketty's book came out, there were a bunch of studies that looked at this in I think France and the US in particular, and that was already pretty immediately a big point. And then the final thing I just wanted to pick up on is the thing that you said, if house prices double relative to earnings, that does have important effects because it makes actually purchasing houses maybe out of reach for some people. I think the right way to think about this from a theoretical perspective is again, it's not how much housing you own, it's how much housing you're buying and selling, and the way, or how much housing you want to buy and sell. So the example I always have is exactly about house prices in London that everyone is familiar with, I guess. Say you bought a house in London 30 years ago in some nice area with lots of nice house price growth. Now maybe you had some kids. Maybe now the kids are out the house. You could think, oh great, I'm gonna cash in on this nice capital gain. I'm gonna downsize, buy a smaller flat somewhere. So in that case, obviously, rising house prices are great for you exactly because you're a seller of housing. The reverse example, where housing prices are bad for you, is a young family in London who maybe either has not bought a house yet but wants to buy a house, or maybe they have a small house and want to upsize the house. Then, of course, rising house prices are bad for you. So it's not about, again, like your holdings of the assets. It's about how much, whether you're a buyer or a seller. And that, I think, if you just think about it like this, then it kind of, that's, I think, the right way to think about the redistributive effects of these asset price changes, in particular for housing. And that's kind of just very, very intuitive.
Thank you. Simon, do you happen to know the answer to this question? It's a tough one to spring.
Yeah, so, when thinking about wealth in the UK, at least, the two main stores of wealth for households are housing and pensions. And as Mike alluded to, there is for the UK story, at least the way that wealth is measured in the UK, pensions is also a big a big factor here. So there definitely will be an increase in net household wealth if you stripped out the house price effect, precisely because we have lots of people who are kind of at or near retirement age with big defined benefit pension contributions, and the book value of those has gone up as interest rates have gone down, which is kind of an interesting thing to think about, because it's not, you know, the income streams from those pensions haven't changed, but the way that they're measured in terms of wealth has, and you know, I think that does tell you something informative on some level. So, you know, if you've got £10,000 a year as your DB promise, that's worth a lot more in a world where rates of return are really low, and someone who's starting out their career would have to save a lot more to get that same rate of return in the future than if rates of return are high, and you know that income stream is more attainable. So I think, yeah, the pension story is important here, but it's kind of conceptually a bit interesting.
So, I mean, actually, an interesting question following up on what's written there on Slido would be, if you strip out all sort of valuation effects, all asset price changes, has there been any increase in net household wealth? Have you guys done that at the Resolution Foundation? My guess would be a small one, but like...
Yeah, so it's difficult because what's your kind of... what's your baseline? Because, you know, one baseline is you have zero returns on everything. So you just save some, you know, everyone makes their savings in cash, and then they erode in real terms, but don't earn any return. That feels a bit mean. You know, we did a kind of simulation that was, what if historic savings earn a rate of return in line with GDP growth? And there is some increase in household wealth, but it's way short of what we've seen. It's massively like the asset price valuation effect. They really dominate the kind of baseline rate of return.
Eleni, any thoughts on this, or on this kind of wider point that we should perhaps look through some of the paper gains in wealth if it's just driven by interest rate change and asset price change? I expect you're going to want to argue the opposite.
Yeah, I mean, I agree with most of the points in terms of, I mean, it does matter more. It matters more for people when capital gains are realized is when it really matters. But at the same time, holding an asset that would have a higher value, even if it's not realized, it gives makes a big difference to people's lives, especially there has been evidence that households who have kids who have high wealth, housing wealth holdings, have better outcomes for their children. Right. So it's the security, I suppose, and the fact that households can, borrow against their high value asset that gives different opportunities to.
Yeah, absolutely. Yes, Mubin was touching on that in his introductory remarks. That's great. No, thank you all. In a minute, I'll turn to a discussion on inheritance, because I think inheritance is coming up a bit later on in the day, just to prime the panel. But first of all, I could take a couple of questions from the floor, if that's okay. James, you've got the microphone. There's a gentleman in the second row. I'm happy to take two or three in a row if others want to. Yeah, please go ahead.
This question, I'm Warwick Life, I'm an economist, and I've been very interested in the measurement of capital and wealth in economies and just how very difficult it is to do. And one of the things I've spent quite a lot of time puzzling about in the last few years is the way in which structural changes have changed the character of asset markets, both in taxation and the structure of capitalist economies, so that publicly traded markets capture a smaller slice of the GDP. So the relationship between GDP that Schiller is so interested in, I think, tells us less about what equities might be valued at, because in the United States, the number of shares trading, firms trading and so on, has atrophied. I think it's fallen by about a half in 30 years. Similar thing here in all the advanced economies. also things that when I worked at the Treasury we talked about, thin capitalisation, the effect of the amplification of double taxation of capital held in the form of equity, seemed very theoretical then, but the vast debts held by very ordinary businesses have changed the valuations. And I just wonder the extent, I'm struggling with this, I haven't got any clever answers to it, but to what extent have these things informed your thinking?
Thank you. Does anyone else want to ask something? Yeah, James, behind you there.
Hi, my name's Omar. Yeah, I was actually just going to pick up that housing point, and I was just curious. Obviously, one of the reasons we have that thought is that people need to live in their home, so it's not merely an asset, and it's not illiquid. Not just that you don't sell it, it's you want a home, right? So it's illiquid in that sense as well. But I think in the UK we have around 5% of people are landlords, so we have a significant amount. So the housing wealth increase is arguably a driver of income, of passive income, well, of real income in terms of rental income. So I suppose I was just curious, there is arguments to tax second homes, particularly these kind of, and that is a big driver of housing wealth. So we're concerned, I suppose there's one concern that the sort of notional increase of housing wealth doesn't really help households who need to live in a house. But there is actually, it's not just a notional increase for some people, and there is also that argument that, and that also speaks to the difference between the sort of absolute and relative change, right? This absolute change has really benefited some people while really making it harder. And it does map on, of course, into the intergenerational difference. So I suppose that was, I guess, a second question. The inequality doesn't seem to be changing in terms of the distribution, but could it be the case that those children who are inheriting from their parents, so it's less mobile, right? So that the inequality overall is not changing, but that relatively the people who are in each point in the distribution are more likely, it's more likely to be generationally stuck, I suppose, is the thought there.
Yeah, thank you. Did I see a flicker of a third hand? It must have been you. And then we'll go back to the panel.
Thank you, Peter Carpenter. If you look at pensions, if I'm holding a bond for 10 years to maturity, it makes no sense to make it market to market, but that's what we accountants do. So I think we have to look at real cash flows. I'm with Jane Austen here. If you try and tax unrealised capital gains, you just end up raising arbitrary amounts of money. And the same's more or less true with trying to tax wealth. You're producing an arbitrary amount of money. So I think in terms of tax policy, you've really got to look at real cash flows to get a good tax basis.
Thank you. Yes, we've got a session on wealth tax section at the end of today, which obviously you'll be at, and also tomorrow Resolution Foundation is putting out a paper on looking very specifically at the next budget and looking at what Rachel Reeves' options might be. It'll be fun to see whether the audience today makes the same sort of recommendations that we'll be making in tomorrow's report. So, I mean, panel, you can give any response you like to those three questions. Perhaps I might just reserve Omar's question about inheritances because I wanted to come on to that one a bit later. But on the other points, Simon.
Yeah, sure. So I can say a little bit on the first half of Omar's question about housing wealth and who benefits. So I think that one particularly important thing to think about when we talk about housing wealth is the role of credit constraints. And to Ben's point, if interest rates fall, house prices rise, but the yield on housing falls in an offsetting way. Housing, in a sense, isn't any less affordable than it used to be, but in a world in which you have to borrow to buy a house, those credit constraints will bind more in that world. So that's exactly what we've seen in house prices rising, but lenders still want a kind of chunky deposit to be able to lend to you. So that deposit constraint becomes more onerous. They also have, in many cases, kind of hard caps on the size of your loan relative to income, and they're kind of slow to move when we change interest rate environments. So, that's something to bear in mind. And to the buy-to-let point, if you owned a house before house prices appreciated massively, you can kind of leverage that new housing equity to borrow more, and potentially, if you already own your own home, you might choose to buy buy to let. And so it has important implications for who owns the housing stock in the UK. I think there's an interesting policy angle there of what do we do about that? Can we do anything to alleviate those credit constraints? Some people think about having sort of a mortgage insurance scheme for high LTV, i.e. low deposit mortgages, to try and make those more accessible and make the supply of them more resilient to changing conditions, so we don't get a repeat of what we saw after the financial crisis, where we saw a big restriction in credit to first-time buyers, particularly who rely on those mortgages. But yeah, I'll let the other panelists come in on some questions.
Ben, any responses?
Yeah, absolutely. Let me also pick up on the housing thing briefly. So I think the right way to think about it again is, very much picking up on what the last gentleman said, is to look at the sort of realized cash flow. So now if you do have a buy-to-let landlord and rents go up, then obviously that landlord benefits. That's clear. And what you do see when, it tends to be the case then when house prices rise, rents rise as well at the same time, but normally not by as much. So the way to do this in the data is people look at price to rent ratios, and you see this moving around a lot. It's sort of the housing version of this Schiller paper I was talking about, right? You see house prices move around a lot, and some of this is due to rents moving or in line with rents moving, but a lot of it is also not. So I would then sort of I would look at the rents, and then I would sort of try to strip out the part of the house prices that's not explained by rents, and I would say that's sort of the part that at least to first order is kind of paper gains, unless you buy or sell, with a little bit of caveats, with maybe you can alleviate borrowing constraints or they tighten if house prices move around. The second thing I just wanted to briefly follow up on the first gentleman. I also don't have these kind of things that I also think about a lot. I also don't have the super best answers, but I think that's exactly what you see happening a lot in the sort of academic literature on sort of wealth and wealth inequality right now, is that there's much more sort of grappling with this, sort of a lot more sort of integration of finance a bit and sort of household finance into inequality literature. So it used to be, again, like if you read Piketty or theories of optimal taxation or wealth accumulation from like 10 years ago, then there's this sort of a view of wealth accumulation in a lot of these theories that's basically like, wealth is just money in your savings account, and whenever the only reason wealth accumulates is because of this sort of active savings. And there's a total disregard of the fact that you basically have, most wealth is some sort of asset that has a price on it that moves around for some reason. Or, these are financial assets that are traded, and exactly then, there's some exchange or some stock market, and then the institutional features of that matter a lot for, what happens there. Firms do engage in share buybacks, that drives stock market valuation, these kind of things. And you see a lot more, this being integrated and thought about. And I think it's sort of still a bit at its infancy, and it's a bit of like, a lot of the people who work on inequality traditionally, don't know that much finance basically, and a lot of the people who work on finance don't really care about inequality, and so, but it's sort of starting to improve, and so hopefully, we'll have better answers for these kind of questions.
Great, thanks. Eleni, did you want to respond to any of those questions?
No, I don't have anything.
That's fine. Okay, well, let's move on to the issue of inheritances, which was part of Omar's question. There was also one question on a very specific point. Was I think that's the other thing that's might be missing. So Simon's characterization was relative wealth inequality hasn't changed, but the absolute gap between the top and bottom is growing. That's the two-clause summary of wealth inequality. But the third clause would probably be, but what about inheritances, and what is the rise of wealth? What is the growing amount of wealth and its inequality doing to intergenerational sort of inequalities and social mobility. Simon, do you want to have a go first?
Yeah, I mean, so it's in part due to the kind of rising value of wealth, like the amount of wealth that's being passed down through the generations is just growing and growing. And, you know, in many ways, our taxation of that wealth is, I think you could characterise it as quite lax. So for kind of housing wealth, there's very generous allowances for passing on your primary residence. It adds up to about £1 million for a couple. But what's most important at the very top of the distribution is these various carve-outs for business assets, agricultural assets. That it's clear in the data when you look at that. I haven't looked at this, but other people have done really great research on this. That the effective inheritance tax rate just drops off a cliff at the top of for the very, very largest estates. So, in a world of rising asset prices and kind of slightly leaky inheritance taxation, inheritances are going to become more and more important. There's some great work from David Storek and people at IFS looking at how this is going to change in the future. And I think it's fair to characterise that as saying that, yes, inheritances are going to become a kind of more, even stronger force in kind of impeding social mobility and kind of entrenching people's position in the wealth distribution across the generations.
Thanks. Piketty put a huge amount of weight on inheritances in his story, probably a bit too much, given that most people now get their inheritances in their 60s, and might go maybe later and later. So he didn't really say much about how wealthy people transmit some of that wealth to their children at younger ages, which of course they do in the UK through human capital. So it's not through financial capital; it's through human capital. Your parents buy a good house near a good school, or pay for a good school, and so your children accumulate human capital at a faster rate than they would otherwise, and that's a key way. Elaine, anything on the inequality of inheritances? I mean, we know. Sorry, it's a huge topic. I'm hitting you with, but I mean, you would.
Yeah, I mean, there is this forecast that the importance of inheritance is going to increase for the impact of inheritance on intergenerational inequality for future cohorts. Yeah. But yes, in the context of in a world where higher interest rates stay or at a lower level than today, but higher than the pre-pandemic level, this may also somehow lessen the effects of inheritance on intergenerational inequality. So this is something that may have some positive effects.
Thank you. So. Ben, do you want to say anything to finish us off? I know.
Just very briefly, I mean, yeah, I do think the inheritance point is important, in particular in the context of housing. Yeah, I mean, if you're in central London, it's sort of, I guess, I've never seen data on this, but it's probably one of the primary ways young people get a house is by inheriting, because no one else can afford it, in a sense. So yeah, that seems important. And no, I just wanted to briefly throw out again this point of step up of basis on death. So not just inheritance taxation, but also capital gains taxation has this interaction with inheritance, and that again there's this. I would again call it a loophole where you completely evade paying capital gains taxes on some assets that appreciate a lot if you just leave them to your children, and that seems like a pretty straightforward thing to change that, and you just replace it with what's called a carryover basis. So you just use the basis at which the house or the stocks were bought. The way, and people do this in lots of other countries, in Germany and Italy, Japan, and it seems to work without much problems. The way they actually do it, it's kind of, because then there's always the question, well, how do you know what something was worth and that was bought like 40 years ago? the way it works in Germany is basically if you cannot provide some sort of a document that proves how much it was bought for, then the tax authority assumes that the basis was zero. So you pay the capital gains tax on the entire appreciation. So people are then actually surprisingly very good at coming up with these documents. Anyway.
Tax incentives at work. And Ben also gets 10 points for correctly anticipating what's going to be in our report tomorrow on what we think the Chancellor ought to
Very
do
good.
at her next
Very
budget.
good.
We'll end it there because you've got a full session ahead of you the rest of the day. So a quick thanks to the panel and
We could start the second session. There I am. That's good. It's good that my voice is now echoing around the room. That's good to hear. So let me add my welcome to you all. It's great to see you here in person and actually talk to you about all the wealth issues that we have lined up today. I'm James Smith. I'm Research Director here in a change of advertised chairing. I'm taking over from Mike Brewer while he thinks about winter fuel payments and the future of wealth tax. So he's got some big things to deal with. So we'll let him get on with that. So we're now entering very solidly the bit where we talk about policy. So that's where we want to be for the rest of the day. We've got a new government. We've got some big issues. We've got some exciting realms of policy to talk about. So that's going to be the focus of the next few sessions. And in this session, we're going to talk about the thing that really gets talked about a lot, which is household resilience, how households are dealing, particularly in the context of the cost of living crisis, what's going on, what's the experience, what can the government do? We've been hearing a lot about that in the context of winter fuel payments. So, it's definitely the right time for that. But there's lots of sort of knotty issues here for us to deal with. Now, to try and help you understand why we're talking about this right now in this session, I'm going to show you a very complicated slide. Now, the trick is not to look at every bit of this slide, but what this slide is basically showing you is a proposal that colleagues here at the Resolution Foundation, as part of the collaboration with Aberdeen Financial Fairness Trust, a proposal on how you might be able to think about household resilience, precautionary saving and pension saving in one coordinated way of thinking about policy. And our shtick has very much been, you need to think about savings policy, pensions policy, overall financial policy in the context of the type of changes we've seen in asset prices. So that's the context here. You need to think about financial policy and wealth policy together. That's what we're going to talk about in this session. I won't get into all the depths of this, but we had a proposal that basically said you could extend your pension saving, but also allow for the building up of a sidecar savings buffer that would allow particularly lower income households to improve their financial resilience. Because at the moment, one risk we have is asking particularly low income families to do a lot of pension saving when they don't have good buffers for day-to-day issues. Anyway, you could see straight away lots of knotty issues, lots of really big things to talk about. So we've got a great panel to talk about that. First, you're going to hear from Oliver Morley, who is with us from the Money and Pensions Service, Chief Executive over there. And then we're going to hear from Will Sambrook, who is been thinking about these in some very innovative and exciting research over at Nest. And then Coletta Smith, who is been looking at this from the BBC perspective, really thinking about what's going on, the big things that are really helping people reporting on all these issues day to day. So that's the plan. I would encourage you, in terms of questions, to use our online question service. So the Slido bit of the events app. So you should be able to put questions in. The key thing is you can vote up the questions you want to see answered, and I can see that on the iPad here. So I'd encourage people to use that. I'm also conscious that I'm standing between you and lunch. So I'm going to stop rabbiting on, and we're going to try and bring this to a close at 12:30. So without further ado, I'm going to hand over to Oliver first.
Thank you very much, and it's very nice to be here at this event today. So I have been Chief Exec of MAPS for around 6 months, and for those of you who don't know about us, we are a government body that we want people to basically be able to share in a really safe financial future, particularly those most in need. And I've spent the last 6 months, a lot of my time has been hearing calls, attending appointments, trying to get a picture as to generally how MAPS operates, how our partners operate, and also what is really happening on the ground. And it's very clear that the importance of financial resilience, and in particular savings, is something that for us is fundamental to that safe financial future. Our UK strategy for financial wellbeing is something we've worked, it's not only ours, we've worked with people right the way across the whole sector. And although there's a new government, we're going to have to think, obviously, work with them to make sure that it supports their objectives on financial inclusion more widely. One of the elements of it that people have been working really hard on has been Nation of Savers, and that is the overall goal to be able to get 2 million people, more people, saving regularly by 2030. Now, that is a hard task. You've got only 57% of people who struggle financially being able to save on a regular basis. And in fact, the Resolution Foundation figure of 27% actually having savings of less than £100 is a really big indicator. And what I hear on the ground very definitely is that, you know, this is creating enormous problems for people, especially when it comes to emergency spending. It drives people into problem debt. It is just generally very, very difficult for them in some cases to be able to meet essentials when it comes to energy or food or childcare. And so we do see it as incredibly important. We still feel Nation of Savers is an important part of it. Some of our work with Nest Insight, and I know Will is going to talk about this more widely, around the benefit of sidecar savings, for want of a better term, the benefit of being able to build that resilience cushion, especially when linked potentially with the pension, and auto-enrolment is an important part of that. But we've also been working with savings providers to develop a UK savings pledge. We would love for more savings providers, financial services firms, to be able to sign up to that, and I'm really pleased to say that today we can say that the NatWest Group and Yorkshire Building Society have said they're going to, are the first two in fact, organisations said they're going to sign up to that. And there's a few commitments, I'm not going to go through them all, but it is really important that we are making sure that savings are accessible, and these providers are making sure that their savings are accessible, and also that customers are really well informed about savings opportunities they have across the board. And for us, working on that pledge, making sure that we have new savings options, new savings products, and also ensuring that that links together to the whole ecosystem of financial help, guidance and advice is a really important part of what we have going forward. But it makes a difference. And as I say, it's been 6 months for me, although I have to say I could hear at the Pension Protection Fund people with direct issues around savings and resilience as well. It makes a real difference, and we are very keen to work with partners going forward.
Thank you.
All right, thank you, Oliver. And next we're going to hear from Will.
Yeah, so thanks, James, and thanks to Resolution for having me at this event today. Just a little bit by way of introduction as to kind of why I'm speaking to you. So I lead something called Nest Insight, which is a public benefit research and innovation centre that was established by Nest a few years ago. And our focus is really around how to increase financial security for low, moderate and volatile income workers, both today and in the future and into retirement. And as James alluded to, since 2018, we've been running a programme partly supported by MAPS, trialling and evaluating workplace emergency savings tools and interventions through a series of trials. Those have included 8 large employers, 3 savings providers, about 150,000 workers covered in the trials. They've included tests of both sidecar savings models, which have this kind of formal rollover link to pensions, which I'll touch again on a bit later, but also more kind of generic workplace savings tools where we've been looking at the impact of auto-enrolling people into those tools alongside their pension rather than just offering them on an opt-in basis. So most of what I'll talk about today kind of stems from what we've learned doing that research and in the other research that we've become aware of as we've thought about it. And I wanted to try and use my opening comments today to do a couple of things. One is just to talk a little bit about financial resilience versus wealth and tease apart a little bit how those things are sort of different but relate to one another and why we think supporting financial resilience is such an important part of a coherent kind of overall strategy, as James was talking about. And then I'll talk about a bit about what we found in terms of what works and what that might mean for public policy. So just in terms of the relationship between financial resilience and wealth. So, you know, kind of at one level, particularly when we think about savings, you know, clearly savings and wealth are related. And, you know, if you think about kind of at the most kind of basic level, kind of savings is something you do in order to build up savings as something that you have, and particularly if those savings are then being put towards retirement or invested in some way or put towards buying a house, and clearly the relationship between savings and wealth is very clear. But a lot of our work at Nest Insight kind of hasn't really been about that kind of saving, right? And so we've been quite careful to try and draw a bit of a distinction between saving, the thing that you do, and savings, the thing that you may or may not have. And that's important because a lot of the people who we see saving through our workplace savings trials aren't necessarily really building up, or certainly not building up quickly, kind of positive asset values. You know, in some cases, they're actually seeing average account balances that sort of bounce around stubbornly close to zero. And I think when we went into the work, we might have thought about that as sort of a failure, you know, kind of why get into helping people to start saving if they're not going to build up assets over time. But actually, as we sort of dug into those use cases, we've learned more and more about the financial resilience and well-being and psychological well-being benefits for people, even if all they're really doing is kind of deferring a bit of money from early in their pay period to later in their pay period, but finding that that means towards the end of their pay period that when there's a really small emergency like shoes for the kids, they're able to meet that cost without necessarily having to borrow or rely on credit to do so. So on the face of it, you can kind of view that as a positive story for financial well-being or resilience or kind of psychological well-being without necessarily thinking it's doing very much for wealth building. And indeed, as we've sort of thought about the policy implications of our emergency savings work, and we've spoken with James and colleagues and certainly looking at their work, you know, one of the things that gets suggested, and very supportive of the proposals that Resolution have made, is this idea of integrating emergency savings into the pensions auto-enrolment mandate and that whole kind of workplace provision. And sometimes when we talk about that, some of the concerns that we get back, particularly from the pensions industry, are around, well, hang on a minute, kind of, are you basically going to cannibalise additional money that could have gone into addressing a perceived undersaving for retirement problem? We're going to end up with sort of a too much cash savings and not really addressing the retirement income adequacy gap. And so I guess what I wanted to do a little bit is using some of the work that we've done, try and kind of lance that boil a bit and talk about how these things really are very complementary. So 3 points I want to make. And so the first is to say that to be absolutely clear, kind of automatically enrolling people into an emergency savings tool at work has absolutely no negative crowd out consequences for their workplace pension saving. And there's a slide, I don't know, James, if you've got the clicker, whether you can fire onto it, but this
your assistant here
this is the only slide I'm going to use, but just, so this is data from a randomized control trial working with employers, and basically what it shows there on the left is when you opt people automatically into workplace emergency savings, you don't see any reduction in participation in the workplace pension, and on the right that the total contributions going into savings between those two tools are additive, so you also don't see any reduction in the average amount that people are saving for their retirement. So we should just be super clear that kind of first question, if you auto-enroll people into an emergency savings tool alongside their pension, might you crowd out what they're already doing on the retirement side? The answer seems to be a pretty unequivocal no.
Will, do you want to just hold people's hands through these charts?
Sure. So on the left, so these are both charts taken from trials where within a workplace some employees have been offered an opt-in emergency savings tool and others have been automatically enrolled into emergency savings tool. So the chart on the left shows for those two groups what is their participation rate in the workplace pension, and as you can see the lines are the same, so there's no difference whether you're enrolled automatically into a emergency savings tool or not. There's no difference in your likelihood to stay in the pension scheme. And on the right, what you can see is total contribution rates, combining pension contributions and workplace and emergency savings contributions for the automatically enrolled cohort are just a jump higher. And what that shows is that their contributions they're making into the emergency savings account are just additive to the contributions they're already making into a pension. Yeah. Okay. So that's the first point. The second point I would make is, with the right design features, then you can create a much more direct link between emergency savings and pension saving, and that's what we tested in the sidecar trials. And what we see in those trials is that if you give people long enough with the additional emergency savings that they're making to build up to a sort of target balance, then you do start to see, admittedly within the scope of the trials in quite small numbers, but you do start to see people then flipping those contributions over into additional pension contributions once they've reached a kind of emergency savings balance. So if you design these features kind of automatically, you can then trigger a direct link between people making more precautionary saving and people saving more into sort of more wealth products like a pension. But third, and perhaps most importantly, is that there's just this whole wealth of evidence that the kind of indirect links between helping households to be more financially resilient in the short term and just their capacity to sustainably build wealth in the long term are really strong. And so you can see that, for example, we've already talked about having precautionary savings reduces problem debt. That problem debt clearly interacts negatively with people's capacity to build wealth. We've done some research, and I'll come back to it in a minute, that shows that actually for some people in the wrong circumstances, directly nudging them into pension saving can actually lead them to increase their personal debt. And so you can sort of see that relationship as well. In the US, there's quite a lot of evidence now that suggests that people who have a basic level of precautionary or emergency saving, pound for pound of income, make higher pension contributions over time and accumulate higher pensions balances, not least because they're less likely to need to use emergency withdrawal provisions that exist in the US system. And here in the UK, there was a paper a couple of years ago that showed that after controlling for income, underlying levels of financial resilience are the single biggest predictor of someone's likelihood to make additional pension contributions in the future. And just to come back to that debt paper for a minute, so if we think about the converse, kind of what happens to those who lack financial resilience if you nudge them into retirement saving, as we've done through auto-enrolment. And as I mentioned just now, when we looked at this, what you see, particularly for those on lower incomes, is that at the advent of automatic enrolment, people did crowd in some additional borrowing to offset the cost of those additional pension contributions. And we've seen other research that also makes clear that the sort of household balance sheet response to auto-enrolment is pretty nuanced, and that for people on lower incomes and with lower resilience, you're certainly not seeing a pound for pound increase in their wealth for each pound of additional pension contributions they're now making. There are offsets both in saving elsewhere and in higher borrowing. So financial resilience through emergency savings might not be directly about people building wealth, but our argument would be that it is nonetheless absolutely critical to think about financial resilience as part of this coordinated overall kind of household finance strategy that James was referring to. And so helping people to be more financially resilient in the short term absolutely contributes to their capacity to save more for retirement, build more adequate retirement incomes, contributes to their capacity to be sustainable wealth builders over time. So really quickly, what works in emergency savings and what does that mean for public policy? So I'll just draw out three things from the trials. Some of you would have heard me make these points before, but I think they're really important. So the first is simply offering people tools to save into in the workplace if they have to opt in themselves doesn't really work. There's lots of evidence about this from our work, from elsewhere. There's the odd exception, but by and large, people only opt into emergency savings tools in very low numbers, usually single-figure percentages. Secondly, opt-out approaches that mimic the approach that we've taken with pensions auto-enrolment really do work. So across our trials, we see a roughly 50 percentage point uplift in the number of people participating relative to opt-in conditions. And we see that across different employers with different savings products and different research designs. We also see, interestingly, that under the opt-out models, it's the people who probably benefit the most, those who weren't previously saving before or don't previously have savings, who are more likely to join relative to the opt-in condition, where the people who have the time and the bandwidth to sort of maximise an opportunity are more likely to opt in. But we do know, and we may come back to this in the Q&A, that there are some real policy and regulatory barriers to employers choosing to offer opt-out emergency savings tools, and so if we want those to scale, if we see those as part of the solution, there probably does need to be some kind of policy or regulatory action to support that to happen. And I'll just finish with an observation about financial incentives. These were talked about in the panel this morning, and they're talked about in the precautionary tales report that James referred to. And you know, that report is kind of, in my view, rightly pretty sceptical about the value of financial incentives as a way to get people to start saving. The evidence around tax reliefs, match contributions as a way of triggering the initial action of saving is pretty mixed, or if not negative, and certainly any benefit of incentives to trigger behaviour are overwhelmingly outweighed by nudges, auto-enrolment type nudges, which just have a much bigger bang for their buck in terms of getting people to start saving. But I would just say, as a sort of final observation, if we were to stop referring to these reliefs as matches, to these tax reliefs and matches as incentives, and start instead thinking about them as subsidies for those who have already started saving, I do think they play a really important role in the system. And this comes back to what I was saying at the start, which is about, you know, if you want people who have started the act of saving to also build up assets, and if you're talking particularly about people on low, moderate and volatile incomes, giving them some kind of financial boost to their own capacity to save is clearly going to accelerate the rate at which they can build up meaningful savings and asset bases. But of course, what matters if you're doing that is that those subsidies and matches target not only the right people, the people who really need them, but also the right behaviours. And if you look at things like the Help to Save programme, for example, the types of behaviour that are rewarded by those matches aren't necessarily the ones that you would necessarily be trying to reflect in a low-income population if you're trying to help them to save. Again, perhaps that's something we can come back to more in the Q&A. But just to finish, I would say, you know, we are, for all the reasons I've just outlined, absolutely supportive of the logic that what's really needed here is a single coherent approach to helping households have financial security, and that things like pensions, the future of auto-enrolment, need to be thought of as a part of that, not as a kind of independent question in their own right.
Right, thank you, Will. Just a reminder to be asking questions on Slido, but before we get to those questions, over to Coletta. What are you seeing, Coletta?
Thank you very much, and thanks for the invite to be here. So my name's Coletta Smith. I'm the BBC's cost of living correspondent. I work across the whole of the UK. I'm based in Manchester. And yeah, like I say, I cover all of the UK geographically. I work to our digital and radio outputs, but most of my day is focused on our main TV bulletins across the national news. So I work for breakfast, the 1 o'clock news, 6 o'clock news, the 10 o'clock news. And as my job title suggests, most of my focus is about how to explain to people what's happening in terms of the cost of living crisis at the moment, and also to reflect what's happening. So a lot of what I'm doing is trying to give people the tools to help them navigate what's been a very, very difficult few years. But I'm also trying to make sure that as an organisation, we're reflecting what's actually happening in the country and the changes that are happening socially. So I suppose the way that I come at the job is I work for the business unit, or the money and work unit within the BBC. So I have an economics hat on as my starting point. And then I'm looking at the social implications of what's happened. So I'm starting from a sort of financial lens, and then seeing the changes that are impacting the fabric of our society, really. And it feels like I've had a bit of a ringside seat for the last 3 or 4 years. in seeing those changes happen, what feels like in fast forward, in that there's been such a huge change in such a short space of time. It often feels like I'm living in parallel worlds because I spend my days in food banks, rummaging through people's kitchen cupboards, talking to them about their energy bill payments, and it's an incredible privilege that people open up, are very honest, are very happy to talk to me about all of those things, while also it feeling like a very long way away from here and from, you know, the organisation that I work in. So, but for them it's entirely normal, and often those worlds don't meet, and I think that's, you know, probably true, and something that the Resolution Foundation are very good at wrestling with, the fact that that policy world, the thought world, doesn't necessarily interact with the reality a lot of the time. For those individuals, I think a lot of the reason why they're wanting to talk to me has changed. So for some, it's a very mad, extreme situation that they're in. You know, it's the family that I met in Cardiff who don't have any flooring in the social house that they've moved into because flooring isn't provided if you move into a social home. For them, that's the norm. For me, that was a sort of mad revelation of what do you mean social housing don't provide carpets or any kind of flooring? So sometimes you get those complete sort of new lens moments on the world. But for a lot of the time, it's individuals who have never been impacted by difficulties before financially and now suddenly are. I suppose it's that normal has become crazy rather than just dipping into a world that has always been incredibly difficult and, you know, crazy to manage. But actually for a lot of people, they're finding huge frustration that their everyday living, which has not been difficult up until now, is just feeling like a massive grind. So I suppose what I was hoping to show to you today, to illustrate to you today, is that idea that it's incredibly difficult to get our own heads around why people aren't saving, and that it's a totally rational and actually sensible decision for a lot of those individuals not to be saving at the moment because of the situation that they're facing. So the first thing for me has been just individuals who are keeping a roof over their own head. That looks very different in lots of different parts of the country, but it's a situation that so many people are struggling with. The first couple I want to talk to you about are called Gavin and Stacey. Nothing to do with Barry Island. Although every time someone comes in their house, they always say, "What's a getting?" Although I can't do a Welsh accent, so. So yes, they are just called Gavin and Stacey, but they live in Halifax. They are tenants. I met them about this time last year. I was putting together a panorama for the BBC around mortgage increases, but they are renters, and they've seen a direct impact on their own lives because their landlord wanted to raise the rents because of his mortgage, and he gave them a Section 21 order. They tried to fight it. They were in the house for about 6 months and eventually were evicted. So they had 3 of their own kids. What we couldn't put on air is actually they had another 2 children living with them who they had kinship fostered. So they were a niece and a nephew from a family member, which made their lives even more difficult and complicated, because that's the reality for a lot of people, isn't it? Life is complicated. They were in a situation of therefore having to find a property that would house 5 kids, and because they were in a fostering situation, they had to have separate bedrooms for the different children in a way that perhaps if they were all their own, they would have bundled them in a bit better. So in order to keep their children in school, they were desperately looking for a big property that was available in their locality to keep access to both primary school and secondary schools for their children. So what happened after that 6 months, eventually after mad levels of searching and desperation, is they overspent. So any prospect of saving, gone, because sensibly they opted to spend more in rent because they had to on a bigger property in their area to keep the kids together, to keep the kids in school, and they are affording it, but everything else has been cut back and the prospect of saving is gone. This is happening, of course, to people with mortgages as well, as we know that sort of rising tide are now of a hugely higher percentage of people who are struggling with mortgage payments or just dealing with a higher mortgage has pushed a lot of families into that situation. So again, for that BBC Panorama, I spoke to a guy called Paul in Taunton, he has a big family home, he's self-employed, runs a business, and their mortgage went sky high. They were rolling with it each month in the hopes that it would come down again. They have actually now fixed. I was in touch with them recently, but obviously at a much higher rate than he was hoping for. So his wife had to take on a second job, and again, bam, they're in overspend because they have to in order to keep up with their mortgage payments. Any prospect of saving gone. So that's one big area, just keeping a roof over your head, whether you're in rented or whether you own your own home. The second situation I was wanting to just draw to your attention is around the issue of children, particularly women who've been through pregnancy and maternity leave. Now, that's something that I have spoken to a lot of women about in recent years, and the particular struggles over the last few years of people who potentially got pregnant and made their financial plans before the energy crisis and have then faced life in a very different situation. So if you are planning a maternity leave, for a lot of people the likelihood is that you get perhaps a little pay from your employer to start with, and then you're on statutory maternity leave for 6 months, 9 months maybe, and then potentially another 3 months of no pay at all. So I remember, must have been about 3 years ago, sitting in County Durham in a circle with a load of parents at a parent and tots group, on our knees, in fact, as the kids sort of clambered all over us, and I was trying to film some logical footage. But with parents who are really emotional about those huge decisions. Do I go back to work after 5 months just to pay the energy bills? I want to spend time with my kids. I want to spend time with my baby. Perhaps I have taken a year off for child number 1. I want to do the same for child number 2, but the reality is I can't afford it. So, or do we just use all our savings and then I do get to spend the time with the kids, or, you know, whatever these really difficult family decisions and social decisions are for those individuals. As a result, people are overspending, not saving, using savings, depleting those savings for really sensible, logical reasons. Just one other area I wanted to talk to you about was actually a lady that I met a couple of weeks ago called Sylvia, who's a pensioner. I was talking to her about the winter fuel allowance, but actually she just mentioned in passing she's, we were looking at their sort of household finances. They're really close to the pension credit boundary, but not receiving it at the moment. And actually a huge amount of their income is currently being spent on effectively insurance for stuff. So she's paying out on gas boiler servicing insurance. She's paying out on extra warranties for washing machines and tumble dryers, things because they're petrified of a big bill. They know that if there is one big bill, it will push them over the edge. So they're actually taking out a lot of their monthly income to secure that, and they're not actually saving it, they're paying it to insurance companies because that feels safer, or they're paying it to British Gas or whoever it is that they're paying those bills to. So again, it's a completely logical reason, but as a result, they're either not saving or depleting the savings that they have. So just to sort of conclude, I wanted just to say, there are a heap of sensible, logical reasons not to save, that if you're thinking about policy to incentivise saving, to get people back to saving, you need to overcome those hurdles in the first place, because that's what the country is going through. It's very different in different areas. Geographically, when we're talking about household costs, smaller satellite towns where rents and mortgages have increased disproportionately more compared to wage growth in those areas is significant. It's impacted young people more, it's impacted women more, particularly those with younger children. And unless those bigger social issues are fixed or people are helped over those hurdles, whether it's incentives or nudges, there's still big issues for people in thinking about saving and reaching that stage.
All right, thank you. All right, we've got about 20 minutes here, so we run a tight ship here. We're going to do the discussion in 3 bits. We're going to talk a little bit, building on what we were just hearing about there, about the current situation, then talk a bit about, what's policy really trying to address, and we get to the heart of that, and then talk a little bit about what works in policy world, picking up a bit on some of the comments we've already been hearing about. Now, Coletta, I'm gonna come to you first. So it really, brings to life what's been happening in the aftermath of the cost of living crisis, hearing all your experiences, actually talking to people who are suffering with the incredibly high price of essentials at the moment. How would you encourage people to think about the level of the sort of crisis at the moment? Should people think about it as a the worst it's ever been? And I have in mind here the unprecedented food bank use, the priority bills that we were hearing out in the first session, or would you encourage people to think of it as more like pockets of problems? What sort of level of problem do you sort of think people should have in their heads?
So I suppose, like I mentioned there, that concept of a rising tide is definitely one that I'm seeing. So for me, it feels as if a lot more people have been impacted. I know there's been a lot of work done on the sort of depth. So those in poverty are in deeper poverty, but more people are heading into that poverty level or just around the just about managing stage. So it's a much bigger number of people who are being impacted. That's definitely true. And I think geographically, it's impacting differently in different areas. That's for sure. Again, that's something I see in travelling lots across the country and being based in the north of England. So, an issue or an introduction of a policy, or when energy bills began to rise, it was definitely felt in some areas faster, partly just because of the cold. We have to stick the heating on much earlier in Manchester. that's a
very
problem
true.
all round.
It's
Don't
cold
even
up
get me
north.
started on Scotland. But it's also obviously to do with housing stock and all the rest of it in those different areas that really impacts people's finances, and it's often way beyond their control as to the moment that they can turn the heat on or the quality of the insulation within their properties. But I definitely, obviously at the BBC we're always searching for big headlines and stuff that's going to grab people, but it is unprecedented, the situation that people are facing. And the other, I suppose, moment for me to notice it is how easily people talk about it. Don't tell anyone, because I like to perpetuate the myth that my job is very difficult to do, but it's not at the moment. As soon as you say to pretty much anyone, how are you feeling about your energy bills right now? Bam, bam, bam. They could keep talking for half an hour, where it used to be quite difficult to get people to open up about their personal finances. It is not a problem now, because everybody feels like they're struggling. That they're happy to talk about it because they know that so many more people are struggling as well, that actually a lot of that shame is kind of disappearing around the fact that they're not able to keep up with their bills, that they are going to a food pantry or a food bank just to top up, where we used to have to be very careful about what we were filming in a food bank because a lot of people would not want to be on camera. That's less and less the case now, and people are very happy to talk about it because so many more people are impacted.
Now, Oliver, I'm going to come to you next and see what you're seeing from a sort of maps perspective. But I suppose, Coletta used the word unprecedented there. That's very clear in terms of the level of crisis we're seeing at the moment. But I draw a distinction between, I don't know, if you look at sort of fairly macro-y type commentaries on this, I'm thinking of the Bank of England, for example, you get a quite sanguine picture, debt is down, households have got more savings as we've been hearing about coming out of the cost of living crisis and the pandemic in aggregate terms. And then you hear a lot about all these sorts of things where, there's clearly lots of hardship. So there's definitely different views on all this. What's your take on this, Oliver?
So we're obviously, our job is to really be thinking about those most in need. So we're not looking at those kind of wider averages. We are very definitely thinking about the people who call us. The one thing I would say is certainly looking at some of the early figures would imply that things aren't worse than they were last year. So that is, I guess, some benefit, but clearly people who are in negative budget, people who have real financial challenges are still coming to us in very, very significant numbers, and we can't, with our partners, we can't necessarily meet all the demand for the kind of help that we would want to give. So clearly there's still a real challenge, and going to Coletta's point, it is only when you really hear it on the ground you can understand some of the real challenges. I think the wider question of savings, it's also the understanding that it is really hard sometimes to save, given all the cost of living pressures as a whole. The benefit of saving is enormous, but I do think we sometimes go off in a direction where it's like, well, okay, let's not try, because some people can't do it. It's very clear that at the margins, there's enormous benefits to having some savings, some pot to protect you, even if the overall cost of living challenge is just enormous. Just having a bit of resilience there is great. And it's not to say that you won't be able to move in and out of that situation because of cost of living pressures more widely.
All right, so let's start to think about the policy side a little bit. And there's a few questions that are coming in on Slido, so thanks for your questions. And I'm just going to pick out one of them. I thought I had picked out one of them, but you can bear with me. Is this how I do it? I'm failing to work the tech.
Okay.
Brilliant. Okay. All right. Thank you. I feel like I may have been saved by the booth in the corner there. But I think this question sort of sums up a little bit how some of the questions we've been having, but also the kind of big challenge here. So I'm going to come to Will first on this. So how should we think about what policy generally is really trying to achieve in this space? How much should we leave families on their own to take care of their own insurance, and how much should the state be stepping in and providing that insurance? How do you have a sort of way of thinking about that question, Will? What would the type of thinking you'd have there?
I guess. So at one level, this is a question about political philosophy, right? And maybe not get too far into that. I guess what I would say is, and picking up on some of the previous comments, so from our perspective, I think there are an awful lot of people for whom life is really hard, and expecting very consistent savings behaviours is unrealistic. But equally, when we see from a lot of our own work, we've just published some work under a project called Real Accounts, which is a kind of ethnographic study of low and volatile income households. People are extraordinarily innovative with how they manage their money at a household level, and people want to save, and people often find ways of doing it. But the system, this is partly a public policy point and partly a financial services point, the system is often not very well designed to enable them to do that in ways that work for them. We talk about human-centered design a lot in industry, but an awful lot of the system is not human-centered in its design. So in terms of, clearly different people will have different views about, the role of the state in terms of things like statutory sick pay, right? Great example of a financial resilience benefit. You can have different views about where the lines on that should be drawn about the generosity of it. I think, where we would, the lane that we've tried to be in is to say, look, there are just some pretty simple things. If we accept that savings and self-insurance is a part of the picture, wherever it bounces up against government support, there are just a bunch of things which could make that a lot easier for people and a lot more automatic for people. And so I think that's where, I'm fudging the question slightly because I think it's difficult to express a very binary view on where do you draw that line, but I just think there is, even allowing for individual and household savings to be a part of the solution, there is still a lot more we could do to make that realistic and a reality for people without necessarily needing to redraw the boundaries of benefit levels or what benefits are available for.
And I suppose one thing I'd really be really interested in all of us take on this sort of whole approach. I suppose the government has, put in place a bunch of policies that you can think of as trying to encourage saving, But I think in the context of some of the work we've been talking about from the Resolution Foundation, is not thinking through in a joined up way the sort of pension plus precautionary saving in the round. But I think one thing I would add, just for people to be aware, that the pandemic was a really interesting case study in all this. So in the US, you basically had households learning that their government, when they got into trouble, would throw money at them. They were huge rise in employment benefits, checks arriving from the revenue service. There was an enormous rise in the financial resources that you saw from households. And coming out of that crisis, what we've seen is in the US is much lower household saving compared to what's been happening in Europe. And we're hearing from Simon this morning about the higher UK saving rate that we've seen since the cost of living crisis and the pandemic. So there's really big macro forces here. At the same time, the UK actually needs to save more if it wants to fund more investment. So there's it's not cut and dry, even from a sort of macro perspective, exactly where you'd want to get to. What do you think on all this, Oliver? I mean, clearly you're looking at the self-insurance end of the market. How do you think about these dividing line?
As I said at the beginning, our job is to help people get the most out of their money, which effectively implies we want to help them optimise. But there are limits. If you're under negative budget and you've got a real cost of living crisis, even if you're going in and out of that kind of environment. So I think, in some ways, I would absolutely agree with, regardless of the wider policy landscape, simplicity, accessibility, these kind of things really, really make a difference to people on the ground. And we're very, very supportive of any efforts to make that journey just easier and simpler for people, even though we absolutely understand when it comes to this balance, the reality is sometimes people just don't have enough money.
Can I just add as well? I mean, so there's something missing from this question, which is the thing that Coletta was referring to, which is also the role of formal insurance, right? So we talk about savings as self-insurance and government support. I think kind of we as a policy sector, industry, whatever you want to call it, haven't done a very good job getting our heads around what's the role of formal insurance in between cash savings and other forms of support. And kind of, clearly in an example where someone has insured everything they own, they are almost certainly over-covered because the likelihood that all of your white goods fail all at the same time is low. But the psychological security of knowing you're covered has a value. And so kind of how do we figure out what's the right balance, which kinds of insurance are good value, which aren't, what's the balance between savings and insurance? That's an area that I just think, it comes up in these kinds of rooms all the time. Everyone goes, oh yeah, that's kind of complicated. And then we all go away and stop talking about it again. So, it's maybe a challenge for us collectively to try and think about the role that that should play as well.
All right, let's move on to thinking a bit about what works in the space of policy. So I'm going to start by showing you two questions that have come in on Slido. So this is from Tim Pike. And basically, what he's doing is sort of asking about the intersection between precautionary saving and pension saving. So is it the case that everybody who needs to build up financial buffers is saving for a pension? So he is basically pushing the Resolution Foundation position a little bit, which I think is a good thing to do. I won't take a sort of defensive tone on that, but I will show you another question, and then I'm going to start with Coletta on what seems to work in this space. Actually, why don't you start on that, Coletta? What do you think? What is your sense from talking to people about what works? And I will show you another question that we should...
I was interested to hear that idea a little bit earlier about actually when you create a savings vehicle that dips down to zero sometimes, if people have that within their workplace savings scheme. And again, that's not necessarily a bad idea. Just thinking about my year, the busy points of the year in terms of cost of living, obviously you get a whole load of changes on the 1st of April to get everybody's head round, but the biggest pressure points for people are over the summer if you have a family, because that's when a big part of your spend comes, and at the start of September obviously if you've got kids into school, but the rest of the focus tends to be around Christmas. So that idea of sort of temporary savings, you know, shorter distance savings, just being able to tuck something away is really important, almost as a precursory step to financial resilience. Actually, I need to be able to cover the flipping energy bills over the winter, as well as you know, all the presents that we're going to need for Christmas, or whatever it is that those individuals need to cover through the winter. You have to get through that before you can then build up those longer term savings. So I mean, from my day-to-day experience, it's incredible to see the work of credit unions in that sort of small-scale savings, in helping people do a bit of that sidecar savings, often through workplace schemes that they have, to save up smaller parts, and then obviously it's getting people into the habit. That's definitely helpful for people to build then a little bit further ahead and a little bit further ahead, and definitely not thinking as far ahead as pensions to begin with, but potentially getting there eventually.
All right, I've completely failed to find the question that I thought was a very good one, so I'm just going to tell you it, which is basically what should be the sort of tax treatment. So this is going to go to Will, and then if we talk about the coverage of, then if I ask Oliver to talk about the coverage of policy that is aimed at precautionary saving. So the question basically was, how should we treat these sort of schemes that try and boost precautionary savings in tax terms? Should we give them a tax break? Should they be completely separate? And how does that fit in with your view about the sort of behavioural versus, I know you didn't want to characterise them as financial incentives, but the more sort of traditional tax type subsidies for saving? How do you think about that?
So I think the proposals that you guys have made about kind of integrating precautionary saving into auto enrolment, they create an interesting opportunity to think about, you know, for example, if you were to calculate pensions tax relief on the total individual contribution and then only split the money into emergency and pensions afterwards, that person would get a little bit more tax relief into their pension than they would otherwise have got, but at the same time be funding themselves for kind of short-term emergency savings. So I think, you know, those of us working in this space, you've said it, we've done it in our work so far, have simplified the world by thinking of non-pension saving as a post-tax thing. But I think kind of as we get further into the detail of how this could work, there are just some really interesting questions about, can you use tax relief? How can employer contributions be designed to try to make sure that just, you know, in the end, don't we want to get to a place where it's as much of a no-brainer as possible for people to save as much as they can? And in a world where, you know, in the workplace and in our tax regime, there's a big push for that saving to be directly and just into a pension. That's not a no-brainer, because there's regret risk with pension saving, which you can't access for 30 years. So I think in a kind of world where, you know, without reversing the progress of pensions auto enrolment so far and the massive steps we've made in helping people have better incomes in retirement, just thinking a bit more about how do we just get to a system where that is a no-brainer, and where the government-funded incentives and the employer-funded matches that go along with that flow naturally to support you in saving as much as you can. And that's kind of the dream goal. There's all sorts of detail about how you would get there around tax relief and things, but that's how I would think about it.
All right, that's really helpful. So we, you know, the system has sort of moved a bit too far in the pensions direction, and you know, we need to rebalance a little bit. Is what I'm hearing in terms of overall pensions policy. In a moment, I'm going to ask the panel to finish with one thing they would like the government to be thinking about and ideally doing. So have your thinking caps on about that. But Oliver, just on this coverage issue, you know, is there a risk here by focusing too much on the pension system that some people slip through the net? How do you think about making sure that we have an inclusive financial resilience type approach at MAP?
Very clearly, this is only one part of an overall discussion, and you can't over leverage auto enrolment to ensure that people have savings. It's one of the it's very definitely an option we would like to see, and we've been fairly open about that in policy terms, but it can't be the only thing. The one thing I will say is that you have 25-year-olds now who have already 3 DC pension pots. We are in a world where people are just building, and you can have wider policy views on this, where people are building a series of pension pots, and the point around accessibility is a really, really important one. There is an opportunity there. More people are effectively, because of auto-enrolment, having effectively the opportunity of a pension, but also don't have that as something that is quite restricted for the long term. And so I think in terms of that wider opportunity, pensions are definitely a place to look. But we think that we are trying to build savers in the round as opposed to just out of the pension.
All right. Now, I'm going to start with you, Coletta. What's top of your list in terms of what the government should be prioritising from what you see?
Possibly my boss will have me strung up if I give government any advice on this one, so I have to tread very carefully. But from what
Tim Davey is not one.
From what I am seeing now, I suppose it's crucial that the government are aware that people are fixed into a lot of the arrangements that they've made over the last year or so for a good while yet. So whatever policy changes that they're going to be introducing, people now have 5-year, 10-year fixed mortgages, have signed a rent deal at sky high already, or have lost all their savings because they've paid it on childcare, or whatever the situation they've been through over the last few years. I think it's crucial to remember that even though the wider economic situation may well be improving, individuals' pay may be improving, that underlying not only erosion of savings but locking into the current personal finance situation has happened for a vast majority of people, and we're going to be here for a good few years yet.
Will, what's top of your list?
So I should also be a little bit careful about how directly I advocate for specific policies.
A lot of carefulness.
I think what I'd say is, there's an opportunity about to arise with the second phase of the pensions review that the government has announced, which is moving on from the first phase, which is all about productive finance, to think more in the round about the design of the system and adequacy. There's an opportunity in the questions that get asked to draw out this debate. Right, and to draw out where the balance sits between direct pension saving versus other financial security and financial resilience behaviours. And so I guess my hope would be that we all collectively, government included, take that opportunity to ask the sorts of questions that you introduced at the start around what does an integrated financial resilience and security strategy for households look like, rather than asking very narrow questions about sort of specific areas of that picture.
And Oliver, final word to you.
I also have to be careful. But I would say...
hate that here.
I know. I would say, for me, the last 6 months have really shown to me something I had been less aware of, but should have been aware of, and that is the incredible complexity in the system. It is so hard for anyone, frankly, but people on low incomes, under real pressure, under ill health, for example, to be able to navigate the system. And so I think generally a request for simplicity is where I would land.
All right. Well, we're always trying to bring you simplicity here at the Resolution Foundation. This is seamless stuff, by the way. Let's thank the panel for a really interesting session there. And the day keeps on rolling.
Welcome back. My name is David Willits, President of the Resolution Foundation. I hope you've all had a good lunch and are ready for a session, the right title for any session immediately after lunch, Where Next? Pensions, Where Next? I'm sorry that Ros Altman is not going to be able to join us today. Her mother is ill and she is with her in hospital. But we do have an excellent panel. We're going to hear first from Nigel People, who is Director of Policy and Advocacy at the Pension and Life Savings Association. Then we'll hear from Jeannie Drake, who is a colleague of mine in the House of Lords, but also was a distinguished member of the Pensions Commission, and Molly Broom, our economist here at Resolution. And now, on this occasion, there is, as always at Resolution, a fantastic set of slides, but they aren't from the Resolution Foundation. They're from Nigel. So Nigel, you set the ball running with your slides, and we'll see how it's done. We look forward to it. Over to you, Nigel.
Thank you very much. Thank you. Let's just see how this... Oh, yes. Pensions adequacy, a pensions industry view. A lot of what I'm going to present are the views set out in a report by the PLSA last year called 5 Steps to Better Pensions. And I felt it was useful to restate the problem quite substantially, especially as understandably and appropriately, people like the Resolution Foundation are thinking outside of the box when it comes to automatic enrolment and what other things might be done. Right, so 4 steps to this. I was told there'd be a comfort monitor. There it is. So our assessment of the problem, and proposals for reform, the outcomes that you get under those reforms, and a few final thoughts from me on the issue. So, just to start off, a restatement of the situation. And I hesitate to do this a little bit with Jeannie Drake in the room from the Pensions Commission, but nevertheless, I'll crack on. In simple terms, when the Pensions Commission looked at pensions adequacy in 2005, they came out with some targets. Some of that, as you will know in this room, was to be achieved through automatic enrolment, soft compulsion, and some was to be based on a voluntary basis. 19 years on, we see that probably only about half of that target level is being achieved by the population as a whole, and a little bit less when it comes to DC savers. And my thanks to the Pensions Policy Institute for their modelling of this work, and indeed they're in the room, which is useful. And then another quick way, if it moves forward. There it goes. Another way of thinking about pensions adequacy is just to compare what people are expected to get through the current system against the retirement living standards that the PLSA publishes and promotes, but they are in fact based upon work by Loughborough University, independent research by them. And the minimum level, some of you will know, is the same as the Joseph Rowntree Foundation minimum income standard, although it doesn't include housing. And I mention all of that to say that, broadly speaking, about a quarter of people are missing that bottom level of the retirement living standards, which is 14,400. That is for a single person. When it comes to couples, 22,000, only need 11,000 each. I haven't got those figures with me, and the situation's better because there's a lot of shared costs. But you can still see it's not everyone, and I guess that's probably part of the background to the concerns in Parliament about the winter fuel payment. And we did, with the help of PPI, do some analysis by generation. And it's quite interesting because what you see is that looking to the future, younger people, at the time we did this, the millennials, although I know there is another generation coming along, they do a bit better out of automatic enrolment, so good policy. But when it comes to higher levels of saving, they're not doing so well, and that's probably to do with the gradual fall in the average value of saving. So there's another issue there regarding the current framework and trying to ensure that people have adequate pensions. Now, as with everything, and again, in a Resolution Foundation audience, I'm sure you're more than aware of this, as with everything in society, it's complicated. And what this tries to do is that underlying those kind of high-level figures, there are many, many exceptions and issues to deal with. And that's important, I think, when it comes to thinking about the solution. So we know that there's a gender pensions gap. We know that people from ethnic minorities tend to have lower levels of saving.
We know the self-employed, of course, well, I say of course, the self-employed are saving lower than they used to do and less than the average. And we know that people in single-parent households, it should say, sorry about the typo, single-parent households are also likely to have lower savings, as are renters. And all but the bottom one of those, I feel, is very much to do with the labour market and how we operate as a society. People often say, well, especially people like me who are lucky enough to work in the sort of middle-class industries, the pension industry, or a trade body, or a member association as I do, who have lucky enough to have money and some savings and maybe even a house, people often say, surely people have other sources of wealth to pay for their retirement income. We need to move with the times. But the reality is, as I'm sure you know, given we're in the Resolution Foundation and the presentations earlier on, of course wealth is distributed extremely unevenly. So when it comes to property, yes, some people have got quite substantial amounts of property, but some people have no property, and also some people have property worth very little. House prices obviously are enormously different across the country. And again, here in London you tend to assume that they're worth something quite substantial. When it comes to financial assets, people have very little. When it comes to inherited wealth, that is changing. Those levels are going up off the back of the housing market, and there will be more of that in the future, but not for everyone. And then it comes to the very important, interesting chapter back in the Pensions Commission report of working longer, which doesn't work so well. Lots of people drop out of the workforce over 50, especially women who are often doing caring for elderly parents or indeed even for children and grandchildren. So working longer is probably not the fix, and you also have health issues coming in there as well. So these other potential sources of financial wealth are not always ready to ride to the rescue. So at the Pensions Lifetime Savings Industry, Pensions Lifetime Savings Association, at the pensions industry last year, we did a lot of thinking about, well, so what's the problem and how to solve it? And we think the problem is that there isn't this clarity, shared political, social agreement about the purpose of the pension system as a whole. There isn't clarity about the role of the state pension. There isn't clarity about who should be in AE, or it doesn't seem to be adequate, perhaps. And there isn't really enough contribution levels, which is something that virtually everybody thinks is the case, who knows these things. And there are also issues about relying heavily on private pensions as opposed to state pension or welfare provision to ensure that everybody can do well in retirement. And so we came up with these 5 steps to better pensions. The first one being to set out clear objectives for the pension system as a whole, including state pension, automatic enrolment pensions, other wealth as well, to ensure the state pension does its job, be clear about what that job is and then do it. And we think that would help governments kind of get out of the constant sort of pressures to always be under pressure to increase it, but on the other hand there's always people missing out, and so there's always a need for welfare payments. Is that really the right solution? And I might just add, we're working with the Fabians on this at the moment to think through a series of options to try and ensure the state pension does its job, or indeed welfare payments. And then there's the issue about getting more people into automatic enrolment, getting up the savings levels. There will be necessary step 4 to think about some of those specific groups who are missing out, where the solution isn't just perhaps raising AE contribution levels or including them in it, for reasons we'll come on to, but something else is needed. And finally, there's an obligation on the pensions industry as a whole to try and do its bit in spreading the word. Now, we have long argued that overall contributions should rise from 8% of band earnings up to 12% of all earnings. We've been saying this for about 6 or 7 years, and that was really because we've seen that people didn't exercise the option that the Pensions Commission would hope would be the case, to do some voluntary saving to keep on track. As you know, people just assume, I'll stop talking soon, people just assume that the rate the government's put them in for must be the right rate, and they're not very clear about what they're going to get at the end of the day. And so that second column there shows that if you go from 8% to 12%, then median earners will probably be getting about the target replacement rates that the Commission argued for. People on lower earnings, maybe they'd be saving too much. So something different needs to be done for lower earnings people, whether it's an opt-down option or a sidecar or even a lower rate of automatic enrolment contributions. And then at the upper two blocks over, the red and the yellow in the second column, that's higher earners. We don't think 8% is going to be enough for them. 12% will be enough for them. They probably need to be nudged to think about doing some more saving on top. Now, I know the Resolution Foundation and Molly is doing some really interesting work on updating the Pensions Commission's target replacement rates to take account of changes in taxation, social security, etc. And so we ran the numbers just to see whether our solution was still about okay with the slightly different target replacement rates listed on the left-hand side, on the right-hand side of the slide as you look at it. And the answer is broadly yes. And we did a little check as well just to think about does our 8 and 12% or 12 plus 4, 16% solutions, how does that work in terms of getting people over the retirement living standard minimum level? And the answer is it's good for median earnings for people on twice median earnings, but maybe it's too much for lower earners. Just a word on lower earners. So here's a piece of work I'm just presenting there briefly that the PPI did for us last year. It was just to examine people under 10k. People who have earnings of under 10k. And the analysis found that, of course, many of those people can't save to afford more. They're currently outside of AE. But actually, maybe about a third of them could do so because they're part of a household where someone else is earning a lot of money. And some of them, have a home, their own, privately owned home. So maybe these are people who are having a temporary drop in earnings before then returning to a higher level of earnings. And there's others who are already saving, maybe they shouldn't be, and there's others who clearly can't afford it. And I only put this slide up to say this whole issue about what to do about people on lower earnings and automatic enrolment, it's complicated, it needs to be looked in carefully. It's the kind of thing I think that would benefit very well from analysis by, say, a pensions review. Okay, so the next slide is meant to be final thoughts. I could definitely do with a prompt, a reminder of that. Okay, so final thoughts, last slide. So, we think, and I think, the UK pension regime needs some clear objectives for the reasons I've set out, that the state pension, and this is a PLSA view, it needs to do its job. It needs to at least protect against poverty. Maybe it can do more, but obviously then you have affordability issues. Automatic enrolment needs to be broadened out and raised, although it needs to be done sensitively and carefully. And for those people who, and I see this quite a lot in my world, who understandably want to solve all the problems that society throws at us through a pension, I would just say, actually, that probably isn't the right approach. There are other things that should be done, whether it's to do with the labour market, for instance, or it's to do with housing policy. And that was my brief introduction. I hope it wasn't too long.
Thank you very much, Nigel. Do come and take a seat. We understand that's your job application to become a researcher at Resolution Foundation with all those fantastic slides. Thank you very much indeed. We're now going to hear from Jeannie Drake, who has thought long and hard on those issues and, of course, former president of the TUC as well as a member of the Pensions Commission. Jeannie, over to you.
Thank you. Well, I don't intend to go into too much detail. I've rather laid out a more reflective piece about where we are and where we can go on pensions policy. One thing that's absolutely clear, we need to return to establishing clarity on the sustainable public good outcomes that government policy is trying to achieve, because without that clarity, decisions made which seem appropriate in the short term risk undermining public good outcomes longer term, and I think we no longer have that clarity. Pension freedoms, for example, turn the private pension system into a long-term savings system, because traditionally pension savings had been generously tax advantaged because they were required to secure an income stream for the citizen over their retirement, whether by pension annuity or cap drawdown. But securing an income stream is no longer required, so we can have great debates on retirement rates, but if there's a suboptimal policy that pulls against that, that's a problem. Pension freedoms meant that the government were more agnostic about how savers spent their savings. So from age 55, you can take 25% of it tax-free, and increasing evidence shows that People see the 25% tax-free as nothing to do with their pension pot. It's a freebie from the government. Grab it while the tax relief is there. They're not embedding it in part of the wider solution. And they can take the rest of their money as quickly as they wish, subject to their marginal rate of taxation. And with tax relief at 50 billion plus and rising if minimum contributions are increased, the challenges of intergenerational fairness and rising dependencies, I'm actually not agnostic. There are worrying signs that DC savers are accessing savings earlier, leaving them exposed to lower replacement rates and means-tested benefits post-SPA. The public good benefits from increasing the state pension age in terms of people working longer, saving for longer, and contributing to GDP could be subject to quite a lot of leakage, depending on the behaviour and the employment rate of older workers. The behavioural assumptions on pension policy are completely contradictory. On accumulation, it's assumed people will not save unless we harness their inertia and compel their employers. On the day of their 55th birthday, we assume for those same people a capacity to understand and engage with complex long-term decision-making, which will overall deliver public good outcomes. And of course, they're not compatible. So we have a plethora of consultations, initiatives, failures in the market. But hopefully, we now have a recognition of the requirement for master trust to be required to deliver guided and default retirement pathways. It's not there. There's more work to be done. There'll be conflicts of interest to be managed. But that has to be in place as part of any solution that you're looking at in terms of replacement incomes. On contribution rates, in terms of auto-enrolment, auto-enrolment policy was introduced to reverse the decline in private pension savings, but also to address the unequal distribution of pension savings and incomes that existed, because there was a very large part of the population that didn't have the benefit of generous DB schemes, and to align that with a policy to focus more of the tax resources of the state on the first tier flat rate pension. That was the intention, to provide both a firm foundation for people to make their private savings and poverty avoidance. And the policy, in our view, needed to be acceptable in terms of cost, the distributional impact, and the administrative complexity. So the second tier provision through semi-compulsory auto-enrolment is intended to deliver a base load of earnings replacement contained within a band of earnings limits and not equal replacement rates across the wide earnings range. We can see that the upper earnings limit for the statutory minimum contributions has fallen too far. So the coverage and the extent to which higher earners can accrue higher replacement rates through auto-enrolment. And it's fallen as a consequence of its links to tax thresholds, which are frozen in order to raise taxes through fiscal drag. So that's clearly an issue that needs to address. But I do worry about a drift into a wider argument that seems to be emerging, that because the flat rate state pension makes a greater contribution to the replacement rates of income for low to moderate earners, then for high earners, the latter need to be compensated with higher statutory auto-enrolment contributions. And it begins to introduce a policy aim for auto-enrolment to deliver much higher levels of replacement rates for higher earners, nearer 2/3, rather than that aspiration being left to the third tier voluntary pension savings supported by some tax relief. Now that's a very, very delicate debate to be had, and it isn't simply a set of charts which make these people save more through auto-enrolment and their replacement rate at £100,000 goes up more. Because the government will make trade-offs. Whatever we design, and we were very conscious of this in the Pension Commission, I mean, these decisions take place in a political context. And the state is exposed to dependency and longevity risk in pensions, health, and social care. And social care is the big casualty at the moment, if you look at the figures. There's a clear trade-off. And with the need for tax resources to support a more generous flat rate state pension, raising contribution levels will be sensitive to reconsideration of both the level and the distribution of tax relief, because it's really, really big numbers. And if you increase contributions, I can't see any government not saying, oh, well, you know, we're kind of agnostic about what it means in terms of that tax relief and how efficiently that tax relief is distributed. And if we take increasing the state pension age and labour market participation by older workers, that was integral to sustainability and addressing issues around dependency ratios. But the SPA shouldn't be seen as a silver bullet. It's an essential part because we need to understand the extent to which increases in life expectancy are accompanied by increases in healthy life expectancy, monitoring the inequalities between social economic classes and regions, and identifying the implications for policies as an important part of a pension age review, because we don't want to price poorer people who die early out of access to the benefits of a improved state pension age because they die early. But if we turn to earnings and rates of return, this is an important area which I fully concede. The assumptions by the Pension Commission on the increase in real earnings and real rates of return were higher than the actual increases in returns over the last 20 years. To borrow from the IFS figures, if I may, earnings assume 2.5, actual 1.8, returns assume 4.8, actual 3.2, which clearly leads to increased contribution rates. But by how much, over what timing, and the phasing of that and staging of that will be pretty sensitive, because the staging is when you bring employers online. The phasing is how long you take to do it. And if anybody reflects on the history of it introducing auto-enrolment, the phasing kept being pushed back. And that was largely driven by things like, my God, if all these people are saving, that's tax relief and tax revenue out the window. So you saw in 2010 that difficult budget for Labour before the election. You saw the same thing when austerity started. So these things are sensitive around staging and phasing. And just over 60% of private sector workers are employed in SMEs. We tend to look at a model of the big corporates, but actually 60% plus are in SMEs. So there is a need to dialogue with employers about how that will be done, especially, and I'm in that camp, if the desire is to see the employer contributions increased. Finally, in the new value for money framework, investment returns are shown gross. And as a trustee, you know, I'm involved in doing VFMs and looking at the new value for money framework. And the argument behind it being shown gross is it enables genuine comparison of the performance attributes of different providers. And we see the concentrations in the market. We see the workplace market providers concentrated in SMEs and other providers focused on the mid and higher value end of the market. So they're not servicing the same market exactly as the Pension Commission predicted. Many providers operate scheme-specific charging, so the AMC charge and the net returns of members in a scheme's default will differ. It will be determined by their employer's specific charges agreement. And that difference in charges and default can be as much as 0.5% from the highest to the lowest charge. And those specific agreements will be determined by such metrics as the value and volume of contributions the employer's employees bring into the scheme. So it does make you think, gosh, there's a bit of a tilt about costs and charges being met in the mass market of the lower earners in SMEs. And then we come to the big hot issue of the day. Pension funds are a major allocator of capital, with successive governments which successive governments believe are negatively affecting the UK wholesale financial markets. In particular, they don't invest in the UK, or they don't invest very much in the UK. And I suppose if you're a government going for growth, whether it's the previous Tory government or the current one, that's quite a big issue for you in itself. And then if you're going to increase contributions and you're going to increase the tax relief going into contributions above the current very high level, you're bound to start thinking, well, am I just pumping more money into overseas investment? How do I align? For me, the big issue was in finding an alignment. You can't do it by mandation. You can't possibly mandate private assets. But there is a debate to be had there, which the government will have, whatever we think. And we've yet to see the outcome of the first review and how UK funds will transition to having more UK productive assets, and that's almost a training session in itself. And AMCs may increase as a result of that transition, but hopefully in exchange for returns longer term, and we're beginning to see the first trickles of movement into UK productive finance in default funds. But it does bring an urgency to solving the small pots problem. Because if you've only got a small pot with a provider, you won't necessarily want to or be able to carry the AMCs or wait the long-term returns. So you really do need to solve that small pots problem. And interestingly, on the investment glide paths for de-risking savers' assets in preparation for retirement, this will affect returns depending on what your scheme does on that glide path. And following the Liz Truss announcement, the talk was of collateral calls on schemes with leveraged LDI strategies. Little was said about the losses, which included myself, I watched it going down, about experience by older DC savers on their glide paths to retirement, and more so if your default was targeting annuity rather than drawdown. And it was quite substantial. And the decisions that were made by your funds about do we manage for people, but they have choices to not go down that route, to annuity or whatever, does affect. And then we know, the FCA is full of reports that, even if you improve returns for savers, those can be completely undermined by poor decisions on access, whether it's drawdown, charges, or I always cry when I watch people who've only ever been 20% taxpayers all their life take the whole of their pot and become a 40% taxpayer, and I think, oh my God, but once it's done, it's done. So anyway, I've just sort of reflected on some of the things I think are impinging on whoever's going to have this second review and sort this stuff out and decide what the objectives are and where the contributions will go, and I certainly support increasing contributions. But I know there are other considerations like the self-employed, gender pension gap, housing, sidecar, but hopefully they'll come up in questions. Thank you.
Great. Thank you very much indeed, Jeannie. Thank you for that very trenchant intervention. Now we're going to hear from Molly Broom here, economist at Resolution Foundation. And I should just say that Molly was away in Paris last week. She was supporting her sister, who was participating in the Paralympics. Her sister has dwarfism. She participated in the weightlifting and won a bronze medal. So will you pass on our congratulations to your sister, Molly?
Thanks, David. Yes, thank you. That's not my achievement. I've spent the last week feeling a bit inadequate myself. Actually, I think this is the closest to a medal I'm going to be getting. So I thought I would spend the next few minutes or so to share some findings from an upcoming Resolution Foundation report, which Nigel has already kindly referenced, which looks closely at the issue of pensions adequacy again, sort of 20 years after the Pensions Commission's first report, and seeks to identify some important questions for the new pensions review to consider. So we start by looking at the target replacement rates outlined by the Pensions Commission, which aim to ensure that people can maintain their lifestyle from working age into retirement. And these target replacement rates were set at 80% of gross earnings for low earners, 67% for median earners, and 50% for high earners. But I actually have a chart here, which shows the annual labour income of full-time employees 2 to 3 years before retirement versus the gross annual income 2 to 3 years after retirement. And this uses survey data from Understanding Society. And what you can see here is that most people, or the vast majority of people who retired 10 years after the Pensions Commission first report had income that fell quite significantly short of these targets. So this raises an important question as to whether the Pensions Commission's target replacement rates are still the right benchmarks for savers to be aiming to achieve. We've also got additional analysis in our upcoming research which shows that the typical retiree today spends less than the Pensions Commission's target replacement rate for a median earner. So in other words, hitting the target replacement rate would actually give middle earners a better standard of living in retirement than that's seen by most retirees today. And so in our report, this leads us to think that perhaps the Commission's target replacement rates are quite ambitious and might not actually reflect the level of income that most people expect to have in retirement or perhaps even need in retirement. There's also an argument that target replacement rates might not be the most appropriate benchmarks for low earners, where the focus is more about preventing poverty in retirement. For example, a low earner might achieve their target replacement rate but still struggle with a very low standard of living throughout retirement. And I think this concern has led to the development of many alternative benchmarks, such as the PLSA's Retirement Living Standards and the Living Wage Foundation's Living Pension Standard. So I think the first question for the upcoming pensions review is whether the Pensions Commission target replacement rates are still appropriate in today's context. The second question, I think, is around the role of policy in helping people to achieve whatever is deemed to be an appropriate replacement rate for retirement. As we heard, the Pensions Commission approach was actually for public policy to aim for a replacement rate which was below target. So the Commission thought that the state pension and auto-enrolment together would achieve around a 45% replacement rate for a median earner. And this was to account for differences in individual preferences and financial circumstances, meaning that it was up to the individual to make additional savings to make up that shortfall between what public policy would get you in terms of a replacement rate and the target replacement rates outlined by the Commission. But I think we should ask ourselves whether we're still comfortable with this 45% replacement rate target, given what we know through auto-enrolment, that most people actually don't make additional savings and the default rates are quite sticky. So people tend to stay at the default contribution rates. I think if the goal is to ensure basic financial security and to reduce the reliance on benefits in retirement, the analysis in our upcoming report suggests that the current system works quite well for those that stay enrolled in auto-enrolment throughout their working life. But if the goal is to ensure that everyone hits the target replacement rates, then the system falls short for median and for middle and higher earners. So again, I think the second question for the upcoming review is whether the aim of public policy is to provide basic security, or whether we should be pushing for higher replacement rates across the board, perhaps through raising the default rate at which people are enrolled at. And then finally, I think just given the discussion that we had in the last section and some of our previous Resolution Foundation reports, I think the review should investigate whether there is a way to introduce more flexibility into the pension system. I think this is important, particularly given the variation in people's financial circumstances, meaning that attempts to increase pension saving across the board might help to address undersaving for some, but may cause others to potentially oversave for their retirement. We've argued in the past that there's a need to move away from a rigid one-size-fits-all pension system. And as we heard in the previous session, there's lots of arguments to move towards a system where pensions become part of a broader saving strategy that incorporates both retirement and precautionary saving. And in the past, we've argued that one way to do this is through introducing a highly liquid sidecar savings account as part of auto-enrolment, and to allow savers to take loans from their pension, as is the case in the US. So I think I'll end there with a bit of a start of 10 of what might be the priorities for the upcoming pensions review.
Thank you very much, Molly. Thank you. And of course, to our online participants, do go to Slido to put down your questions. There are some coming in already. But while they come in, why don't I just briefly invite Nigel and then Jeannie to comment on Molly's challenge about replacement rates. I mean, is that the right framework for policy? How radically should that be changed, do you think? Nigel first and then Jeannie.
Well, I think it was always the case from listening to members of the Pensions Commission that it was perhaps quite a subjective judgment about what should be the right amount to target. But certainly when you ask savers, do they want to have better retirement incomes, they say, yes, please. And they, as I've said, they assume that the automatic enrolment rates they've got are in place. So I do think it is a complicated issue. It's not clear. I think everybody agrees it's really fundamental that the system gives you that solid baseline, protects you from poverty, gives you a standard of living to take part in society, like is identified by the Joseph Rowntree Foundation work and the PLSA minimum. Beyond that, of course, people aspire to carry on with their lifestyle if they can afford it. But whether they've done enough savings is another matter.
Jeannie, what's your view? You've obviously wrestled with it.
Well, I mean, the Pension Commission view was struck at a point in time, and times change, and if things are fit for changing, they should be changed. And any settlement will be set in a political context. There's no point in pretending that it isn't. So, although you want to be intellectually pure, you have to have an element of pragmatism if you don't want it just a report collecting dust on the shelf. But I mean, Molly does raise some important issues because it is this tension between the average and lower earners, which the state has a real interest in because they're going to make less demands on the state if they're catered for, as opposed to the aspirations of higher earners and the role in the state in providing for that. I'm not going to say here where I think the line should be, because that's for the review to do and look at all the figures. I would probably go into that room needing some persuasion to lift the replacement mates very significantly once you start going up the higher earnings, for a whole variety of reasons. One, it's got to be sustainable, and you're making a decision about the allocation of tax resources. And secondly, there are other sources of wealth and income that people have. But I do agree it's something that should be looked at in the light of the evidence that's there. What I don't want to go is, well, I've looked at it all and decided where to jump. But I agree it should be looked at.
Fair enough, thank you. And actually that does lead on to another question, and I'm going to begin with Jeannie on this as well, which is Emma Reynolds, the new pensions minister, in her first main public speech last week, kind of appeared to put the next stage of the review and the work on auto-enrolment, put it rather on the back burner, and said that her priorities were to promote more pension investment in the British economy and also to secure better returns from the investments already being made in pensions, which was interpreted as not embracing the kind of auto-enrolling agenda that we have worked on so hard at Resolution Foundation and others for how you might refine and improve auto-enrolment. Is that the correct judgment? What do we think that means for the timetable for the next stage of the review? Jeannie, what's your reading of what the new pensions minister has said?
Well, I mean, I think she's saying what the Chancellor has said and what Conservative Chancellors before have said. And it's like I say, pension policy always has its political context because it's a very expensive proposition for governments to deal with, either in terms of state benefits or tax relief. And the issue is basically if you're going for growth, which both previous government and this one wanted and saw, and you've stuck in low productivity, and you can see a very large part of, and you're going to want to try and find more. I mean, you just are, and therefore saying, well, can you just deal with that over there? But meanwhile, can you give a load more tax relief and increase savings pots a great deal? Is probably a political decision. They're adopting, aren't they, that hesitancy that the previous government did. Is there a way of dealing with the efficiency of the capital markets more favourably in the UK's interest? I mean, if the will is there, it can be done. I mean, looking at Emma, who will know. You can already see what I call the more sophisticated and established market providers have already started on work on this. Some of them are bringing to market default with more productive finance in. So you can feel the mood change that's coming. But it would be naive of me to say, oh, the government's just going to rush ahead with increasing tax relief and contributions unless they're more confident on this issue.
Yeah. Nigel?
Yes, I mean, I think as has been clear for a few weeks with the announcements about the pension review, it's clear that the government wants to crack on with the issue about growth in the UK quickly, and then perhaps reflecting the kind of issues we've already been discussing, taking a bit of a step back to think carefully around adequacy. I was very pleased nonetheless that the second stage of the review is going to deal with adequacy, and we wouldn't only have a review on the investment side. And if I may add another quick thing just from the pension industry perspective, so we came up with 6 ways to try and draw pension fund investment into the UK, and only one of them was linked to having higher automatic enrolment contributions. And I will run through them. One, a little bit tricky, fiscal incentives for investing in the UK. Obviously people say, well, maybe they'll take some of that money away somewhere else, but fiscal incentives to invest in the UK versus other countries, this apparently is something other countries do. Adjusting the rules that apply to automatic enrolment and the duties on the employer, so they have to be thinking about high performance funds, not just very, very low cost funds, which is often what they want to do. Yeah. A really hard thing for government to be thinking about, are we being strategic? Do we have an industrial strategy that will help make the UK an extremely attractive place to invest in? Things like housing, planning reform, skills, etc. A couple of other ones. Flexibility on the DB funding rules, facilitating the consolidation of schemes through the rules that apply. And there's things like the value for money regime that's being introduced will do that. And there's one other which I can't remember now. So I think that probably covers off issues for stage 1 of the review.
Before Jeannie comes back, we're going to get back to Jeannie, but could I just ask, actually, as you're going through that list, one other question about investment, which is that with the change of interest rates, pension funds are now sitting on very large surpluses. One calculation I've seen is that they add up to £250 billion. What's going to happen to the surpluses? And with, of course, there are legal constraints, but do you think the surpluses do you have any imaginative ideas about how those surpluses might be invested?
So the previous government, as you'll be aware, undertook some consultations about DB surplus, as we call it, and how might they be used. Apparently the DWP, Emma Reynolds, is thinking about these issues in parallel at the same time to the first stage of the pensions review. And there have been a range of thoughts about that. Could some of the money be returned to the employers or to the employees? If they've got an existing single trust, which is both DB and DC, then there really are opportunities for saying that some of this money could be used to enhance DC contributions. And indeed, I was actually hearing about a scheme that was doing that. But obviously, the money is really there for the purpose of the trust, and the purpose of the trust was to pay the pensions as set out.
But are there many schemes which are a single trust, often with an old DB and a newer DC combined? Is that an unusual arrangement, or is it widespread? That's a genuinely neutral question. I don't know the answer.
Yeah, I think
it was. I mean, the first reaction to closing your DB was to open a DC section of your trust-based scheme. But over the last few years, more and more employers working with trustees have chosen a DC provider, and you have 2 jobs. The employer chooses the new DC provider for future contributions and asks the trustee to transfer the accrued DC savings over to that provider, and that's been moving at a pace.
Yeah, so it's a diminishing opportunity, and again, it makes the issue hard, but the government is looking at it.
And Jeannie, I think you wanted to comment.
Yeah, I just wanted to be really provocative on the productive finance, because in a sense, you can look at, do you find a solution to productive finance under the existing pension system, or do you amend the pension system? Do you add another tier? Do you have another nationally administered tier for the new contributions? I mean, I think it's an open book out there. Heaven knows what they're doing, but I don't think we should necessarily set the boundaries of where the solution lies. I mean, I think
That's your microphone, by the way.
Oh, sorry. I think on the surpluses one, I mean, because of the way in which liabilities are calculated, with the gilt yields, then schemes have lost lots of assets, but their liabilities have gone down, so they're in surplus. And there are a lot of employers, not just trustees. I mean, it's always portrayed as all the trustees want to rush off and get DB. They do, because some of them do if they're not that confident on the covenant. But there's a lot of employers do. This is their best chance. And if you look at the DB activity that's taken place, a lot of financial bodies like banks have gone because their surplus or deficit affects their capital adequacy. So there's lots of employer drivers for going for DB. In terms of those that don't go for buyout, but for those who don't go for buyout, then obviously it'll depend on their trustee how the surplus is dealt with. But I mean, it isn't the concept of letting the employer have the surplus back. It is, how do you measure and define that a surplus exists? That's where the controversial debate will be.
Right. Yeah, because there's always been the possibility of getting back a surplus, but it depends on how you define surplus. May I make one very quick extra point?
Of course, yes.
Just I think it's useful to think about the pensions landscape as being a series of different challenges when it comes to the growth issue. So you do have private sector DB. Obviously, there's some funded public sector DB, and there's DC. And each one of those operates in a different set of legal and regulatory requirements, and each one of them can be enticed in different ways to invest more in the UK. And I just want to come back to that point mentioned by you, Lord Willits, about the developments that are happening in the DC space on the back of the Mansion House Growth Compact, where DC pension scheme providers have been setting up funds with a strong focus on growth and with a commitment to try and have a substantial part of that within the UK. And that's happening. All of this takes time, but it is happening. It's going to get better, I think.
Right. Molly, anything you want to add on that from a Red's perspective? Now, I got one online question, which is particularly for you, Jeannie, asking for your comments on the cost of pension tax relief and how you would reform it. Level up at 30%, restricted at 20%, and how would you treat DB schemes in this new world? I don't know quite what that means. But so Jeannie, you designed the tax relief system in front of our eyes.
Yes. Well, I tend to favour reforming the tax relief system and shifting over time to a more flat rate approach. But again, how you would do it and the time scale over which you would do it is something you'd want to sit down. I hate jumping for this is the definitive solution until I've kind of fully looked at something, but I favour a more equitable distribution of the tax relief. And actually it gets rid of the lifetime allowance argument, because you're not really interested in a lifetime allowance, you're interested in how much tax relief you're allocating to these savings. So tackle the tax relief, and that deals with it. And that's a very sensitive issue, as we know. But if I was thinking about it, I would want to look at the figures to see if they supported moving to more of a flat rate system of tax relief above, not at, above 20%. DB, of course, is much more complicated and, of course, is very sensitive in the public sector, which is now the main depository of DB schemes. I mean, even the open ones tend to be with ex-public sector, like railways and universities. So that's an extremely sensitive issue as to how the tax relief is calculated. So I think that would have to be a sub-project, definitely.
Right. Okay. I think that's. I think you've just about walked across the minefield without exploding anything there, Jeannie. Now, do people here physically with us have any questions? We have a mic. If there is anyone here in the audience who wants to put in a question, yes, we'll take 2 interventions.
Jeannie, I was very taken by your comment about de-risking pension funds as you get older.
Yes.
And it doesn't just affect pension funds, it affects all manner of savings where people think they're doing something that is really quite safe. And it turns out they're taking quite a lot of risk with a fixed income asset in the event of an increase in interest rates. Yeah. And I had a very small auto-enrolled pension courtesy of Policy Exchange. And it was fascinating to see what happened to that when the interest rates went up. Fortunately, before they went up, I just went straight into cash. But I feel very worried about many people who are less familiar with the bond markets than maybe I am.
Before the interest rates went up?
Yeah, because I avoided having my pot go down
Yep.
when the rates went up.
Yeah. This is what was this the moment Liz Truss was elected as Tory leader?
Yeah.
It was during COVID in 2020 when I saw that monetary policy was going to have to be tightened.
Right. Very good. Yes. Very interesting. And then let's collect the second question.
Thank you, Emma Douglas from Aviva. I'd just like to hear the panel explore a little bit more what Molly was talking about the ability potentially to access your pension through a loan. I think particularly in the interests of maybe getting onto the housing market, because we do see that there's some quite horrible things coming in the future when we might see pensioners being renting in retirement, you know, and if we could help people get onto the housing market through their pension, be really interested to get the views of the panel on that. As a pension person to the core, I'm slightly horrified by it, but I feel that we need to explore it further.
Yeah. Molly, do you want, because I think James gave a couple of slides summarising our model this morning, but Molly, this is not, you've worked on this long and hard. Do you want to comment
sure,
on that?
I can take that. So for those that weren't familiar with a report that we published earlier this year, we made the argument that as part of the next step of auto-enrolment, if you were to increase the default rates, then you'd want to allow some flexibility in accessing pension savings, one through a sidecar savings account, which has been discussed and trialled by Nest Insight, but also to allow for people to manage larger shocks, allow people to access loans of up to £15,000 or 20% of their pension pot. And these loans would only be available for those that sign up to a repayment program. So once you are meeting auto-enrollment criteria, you would automatically make additional contributions to repay that loan with interest to reflect the foregone returns you otherwise would have forfeited by taking that money out. So the reason that we thought that that would be a good idea is that the sidecar savings scheme would allow people to manage sort of small cash flow shocks. So, you know, your dishwasher breaks and you need to replace it, or that kind of small shock. But people often face larger shocks. So whether that be a period of unemployment or bereavement or family breakdown where they need to draw on larger amounts of savings. And we think the pensions infrastructure is one way that you could do that. There's lots of evidence from the US that this actually works pretty well, that people do tend to pay back the loan in full and continue to make contributions to their pension while doing so. What's slightly different in the US is that if you don't pay back your loan, then you do pay a fine, I think, of 10% on the loan amount. So we're not suggesting that you would do that, because if you're not meeting auto-enrollment criteria, not automatically enrolled in repaying it, then we think that you shouldn't be hit with a fine for not repaying it. But I think the evidence from the US shows that this could be a system that works quite well and gives an additional financial security and additional route for people to access money in the face of sort of large financial shocks.
Thank you, Molly. Nigel, do you want to, just as we're coming to an end, do you want to give your final observations on those two, perhaps on either of those two questions, or anything else you want to say briefly?
Yes, I think, so we did explore those issues a little bit earlier in the year with our members, and I suppose, it's true to say they were quite cautious about it, because you can't spend the money twice. Now, I think that doesn't mean to say that there isn't good sense in maybe using the concept of auto-enrollment to do some genuinely sidecar savings, but then you need some money into sidecar, and ideally there'd be also money into pensions. Not sure how that will play out, but it's the kind of thing I think the pensions review second stage could look at. And obviously, sorry, on the housing aspect of things, we have been wondering about whether there was some way of being able to just use it as a collateral to be able to get the loan, so that you almost would never actually have to raid it. So definitely worth exploring a bit more. And then on the interest rate, I just wonder if the gentleman's got any tips for me now,
Yes.
whether we should buy the bonds now, because as interest rates are coming down, I was reading in the paper at the weekend that this is a good time to hold bonds.
We're beyond the no-brainer territory.
Jeannie, final comments for you.
Yeah, I'm unashamedly opposed to solving the housing market crisis by rewriting the pension policy. You know, the housing market crisis has to be dealt with by increasing the housing stock, revising the planning rules, and something else. If you over-rely on early access to your pension policy, you don't know what the behaviours of people will be. You risk inflating property prices because you unleash a whole load of money. It'll favour children whose parents are well off, who can help them to save more, so they get access. So I would take some persuasion to go anywhere near there. But the area where I do think is more what I call the step change territory, where particularly where people have short financial shocks, immediate financial shocks. And I haven't seen the latest step change figures, but I remember Helen Dean, when she was at Nest, because they're developing the sidecar, saying, and she thinks she's on the board of Nest, saying £1,000 in access to liquid cash would prevent most people from falling. So I'd like to really understand those figures. And, you know, I'm not averse to that kind of sidecar, because I think financial resilience is a big problem in this country. And if you could route your pension contributions, I'm looking at Emma again, because she knows all about how it works, so that you kind of held a cash pool. So as you flowed through, there would always be this little cash pool, quite modest, 500 to 1,000, which would help with short-term financial resilience. I would want to look at that. But you'd have to sort of be careful that you hadn't given, you know what governments are like, create an opening and it becomes a fissure. You know, like, oh, I'll not do that for this and the other.
Thank you very much. Well, that, of course, is the proposal that Molly has been working on, and I don't think you can have a more ringing endorsement than Jeannie saying not averse. So we will pocket that as a gain for the day. Thank you very much. Thank you all very much indeed for coming on. Thank you to our panel. It's great to have Nigel and Jeannie with us, as well as Molly, of course. And we'll reassemble in 38 minutes at 22. Thank you very much indeed. Session of our conference. Thank you very much for those of you who stuck with us all through the day. We have been analysing wealth, changing patterns of wealth ownership, housing assets, pension wealth we've just been discussing in our last session. Now is the final juicy bit, taxing it. I've got the privilege of one Resolution Foundation slide, which I put up as a background to the discussion that we are going to have. The one line, the rapidly rising line, is the slide you'll recognise showing assets growing relative to GDP. Query, and we discussed some of this morning, exactly how high it went and whether it's now declining, but it somewhere 7 or 8 times GDP, a long sustained change. And then down at the bottom is property taxes and revenues from property taxes as a percentage of GDP. And you can interpret this different ways. You could say pathetically flat when there's such a surge in asset values. On the other hand, the time series starts in 1965. We can't go further back than 1965. And where we are now, at about 3.5% of GDP in capital taxes, is the highest level since this series began. So it has actually gone up a bit. I would add that one of our concerns here at Resolution is that by far the biggest part of this is council tax, which is a particularly defective and regressive tax. And in a way, Britain could be proud of 3.5% of GDP now going in capital taxes, given what's happened to asset values, were it not that the highest single source of it was so unfair, and particularly managing to have something that is defined and accepted by OECD as a capital tax that is in fact borne most heavily by low-income households does seem a bit perverse. But there is obviously now a very lively debate on what the other options are on capital taxes, and indeed we at Resolution Foundation will be publishing a report on this tomorrow. But now we've got 3 excellent experts to take us through this final stage. We're going to hear next from Sarah Perrett, who is the head of the OECD's Centre for Tax Policy and Administration, and we'll then hear from Professor Aaron Advani from the University of Warwick and from Martin Sandbu of the Financial Times. But first of all, over to you, Sarah.
Good afternoon, everyone. I'm very happy to be with you today. So in my introductory remarks, I'm going to try to give you a very brief overview of wealth taxation in OECD countries. Sorry, does this work? Yep, perfect. And then very briefly discuss some key policy considerations when discussing potential reforms in this space. So we've been seeing growing interest in wealth taxation in recent years, and it's been driven by a number of factors. Number one, the historically high value of household wealth and the increasing concentration of assets at the very top. Governments in general are also facing rising public revenue needs, and that's linked to high public debt levels, but also challenges like population aging and climate change. And so governments in general in the OECD are exploring scope to raise more revenue, and they're particularly interested in tax bases that might be underutilized. At the same time, there's been recent evidence of comparatively low effective tax rates at the top of the distribution. And so it seems that from a tax morale or a social cohesion point of view, it's going to be difficult for governments to try to raise more revenue without paying close attention to fair tax burden sharing. And we've been seeing some domestic reforms in different countries, some interesting reform proposals, including one that's getting a lot of attention in the US on taxing unrealized gains under certain conditions, as well as some international calls for action on tax inequality, most recently in the G20 declaration of last July. So there are many forms of wealth taxation. You can tax the income from wealth. You can tax specific assets through property taxes. You can tax wealth transfers through inheritance and gift taxes. And then you can tax overall net wealth through a wealth tax. And so what I'll try to do is go through these main categories with the exception of the property tax, which I think is slightly less relevant in the context of this discussion. So if we look at the taxation of capital income and we focus on dividend income taxation, we released a paper last year which shows that there are wide gaps between wage and dividend taxation in OECD countries in general, but these gaps tend to vary. And that's true even when we include corporate level taxation on these incomes, so in particular corporate income tax. If we look at trends over time, there has also been a decline on average in OECD countries in the overall tax burden on dividend income, and that's largely been due to the widespread decline in corporate income tax rates. And of course, these gaps between labor and capital income taxation have a number of consequences. They reduce equity, but they also give rise to incentives for owners of closely held businesses to shift from highly taxed labor income to lower taxed capital income, and we do have evidence of these behaviors. Capital gains taxation is another way to tax the income from wealth. And what we observe in OECD countries is a particularly favorable taxation of gains in general in OECD countries. So they're typically taxed upon realization when assets are sold, as opposed to when assets appreciate in value. It's not mentioned in this slide, but in general as well, with a few exceptions, countries tax nominal capital gains as opposed to there's no inflation adjustment. If we look at how sort of common aspects of capital gains taxation in OECD countries, we also see that they're taxed at lower rates than other income, in particular labor income. And that's done through a variety of systems. So it can be flat tax rates on capital gains. The most common approach in OECD countries is to have flat taxes on gains. You have other countries that have lower progressive rates, and that's the case here in the UK. It's also the case in the US. You have some countries that tax it with other incomes, so tax all personal income together, but provide special exemptions for gains. That's the case of Australia and Canada. And then some countries that generally do not tax gains on shares, and that's the case in Belgium, in Switzerland, and in New Zealand, for example. There are also specific assets that benefit from additional relief. The main one is the main residence. In a majority of OECD countries, capital gains from selling the main residence are fully exempt. And business assets also get special relief, capital gains tax relief in a number of countries. Many countries also provide relief for unrealized capital gains upon death. In particular, the countries that provide step up in basis, where I think you call it CGT uplift here, is that right? And so where the value of assets is stepped up to their value at the time of the inheritance. So effectively that erases unrealized capital gains upon death. And so what we see in general when we look at capital gains taxation in OECD countries is that they're taxed highly preferentially, and there are significant tax deferral and tax minimization opportunities that arise primarily from the fact that these are taxed upon realization, but also because of provisions like CGT uplift. If we look at the tax transfers, a majority of OECD countries levy inheritance and gift taxes. So it was 24 out of the 36 OECD countries we looked at. But some have repealed these taxes in the last couple of decades. So Austria, Czech Republic, Norway, Slovak Republic, and Sweden have all repealed their inheritance taxes since 2000. These taxes generally account for very limited shares of overall tax revenue. So if we look on average at the revenue raised from inheritance and gift taxes in OECD countries, it's around 0.5% of total tax revenue, so very low. And that's largely the consequence of narrow inheritance and gift tax bases. And in general, what we observe is there can be generous relief for transfers of wealth to close relatives. There can be special relief for certain assets, in particular business assets, pension assets, life insurance policies. And many countries also provide more favorable tax treatment to in-life giving. And so there are tax minimization opportunities through in-life giving in many countries. And so as a result of that, what we observe is that a majority of estates go untaxed in a number of countries, and that effective tax rates decline for the largest estates in some OECD countries that we have data for. Final main category of wealth taxation is actual wealth taxes. What we've observed is that there's been a decline in the number of countries in the OECD levying annual wealth taxes. There were about a dozen OECD countries levying wealth taxes in 1990, and today it's only 4. So Colombia, Norway, Spain, and Switzerland. Again, these taxes only generate limited revenue. On average, in the countries that had and have them today, it's less than 1% of their total tax revenue, so it's a small revenue raiser. An interesting feature of wealth taxes, in particular past wealth taxes, is that they were typically levied on relatively moderate levels of wealth. So they're very different actually from the wealth taxes that we saw in European countries in the past. Were actually very different from the wealth taxes that are currently being discussed and really target the ultra wealthy. And you had a number of issues, resulting from that, in particular liquidity issues, but that was in large part because they weren't targeting the ultra wealthy. There's also a lot of reliefs for different kinds of assets, often the same ones that get relief under inheritance taxes. Also some practical difficulties that are more inherent to wealth taxation, in particular the need to regularly value assets. And then lots of also, if we look at past experience with wealth taxes, opportunities for tax avoidance and evasion, in particular hiding assets offshore, because it was a time when bank secrecy was prevalent and there was an exchange of information between tax administrations. So there was a lot of offshore tax evasion going on. To conclude, I think this was just to give you an overview, but there is room to reform wealth-related taxes in OECD countries in ways that would enhance efficiency, that would enhance equity, as well as tax revenues. The best instruments will depend on the ultimate objective. Are countries predominantly focusing on raising revenue? In this case, there are probably lots of options they can look at. If the goal is to really reduce wealth gaps, there are fewer instruments that can help a government achieve that effectively. Different instruments involve different policy and administrative trade-offs that need to be carefully looked into. And I don't really have time to go over this, but this is a very simplistic summary table that looks at the pros and cons of taxing capital gains on realization versus on accrual versus having an annual wealth tax. And so it shows that, you have pros and cons and you need to carefully consider those. There needs to be also a close consideration for the interaction between these different tax instruments. There's overlap between the tax bases of the different taxes I talked about, and so looking at how these interact is very important. Tax design is key, and as you can see, the devil is always in the details, and most of the issues arise from the design of tax bases. International cooperation is also essential. There's an international dimension to taxing wealth that can't be neglected, and in particular we need to continue efforts to exchange information between tax administrations to make sure that tax administrations know what their taxpayers have abroad. And of course there are political economy constraints and some taxes that are easier to reform than others, and it's not always the existing taxes that are easier to reform compared to introducing a new tax. But I'll stop here for now. Thank you very much.
Thank you. Thank you very much, Sarah. Now we're going to hear from Professor Advani, who is Associate Professor of Economics at the University of Warwick. He's also a research fellow at the Institute of Fiscal Studies and a visiting fellow at the International Inequalities Institute. So, Aaron, over to you.
Great, thanks very much, and great always to speak after Sarah because she covers all of the big picture things, so I can just get very focused on the UK. So the question was, that I think we're challenged with this panel is to think about the taxation of wealth over the coming decades. Where are things going? So I think it's helpful just to think a bit about, following from what Sarah said, where have we been? Where we've been in the UK, as a lot of countries, is a position where we've kind of lightened the load in a sense on wealth, and that was partly because the academic consensus, I'm from relatively professorial, the academic consensus really pushed in a direction that said actually taxing wealth was really harmful, that it could have really bad effects. And so the academic consensus really was this could be very dangerous. There were really strong reasons not to do it. The academic evidence has now shifted. We've now got evidence of other issues. Things are moving. But things have shifted in terms of our understanding of the other behaviors that are going on. So I think there's just, the academic guidance on this is not very clear anymore in terms of, is it definitely a bad idea to tax wealth? It's not clear. It's definitely a bad idea. So it leads us, in a fortunate way, to turn to the practicalities of what might this look like in practice. And the great thing for the UK, looking at the challenges we have, which are firstly revenue. I mean, it's clear that the government, whatever you think about black hole numbers and whether these things should have been foreseeable, it's certainly the case that any government over the coming years, whoever it would have been or whoever it is going to need to find ways to raise revenue because the public sector's had some fairly tight settlements for a few years now, and it's clear that we need also additional public investment. And that ties on the public investment to a second challenge that, again, any government now would have faced, which is growth. Growth has really been abysmal since the financial crisis. There's lots of reasons for that, and there's certainly no, I mean, the Resolution Foundation has, over the past couple of years, however long it's been, the Economy 2030 program has gone through and looked at a number of reasons for these challenges. Yep. But one of them, genuinely is the way in which we tax things. And so one of the nice things for the UK is that taxing things better can help us improve our growth prospects at the same time as raising revenue, because the tax system has lots of problems in it that can be solved. And in solving them, we both raise revenue and actually improve efficiency. So a classic example of this is capital gains tax. Capital gains tax in its current form has a lower tax rate than taxation on earnings, but it taxes all capital gains, whether or not they are real, whether there's actually an actual gain that you made, or whether it's just inflation that was being taxed, or whether it's just the cost of borrowing that's being taxed. It doesn't distinguish between those kinds of things. So back in 1988, we had a reform to taxation of capital gains tax that took inflation out of the tax base and said, we're not going to tax paper gains, we'll only tax gains beyond that, but those gains that are being taxed will be taxed like income. Having moved away from that, what we've ended up with is a situation, we've done work to show, we've ended up in a situation where both we end up with people switching from being super efficient employees, doing a wonderful job in some organization they're part of, to saying, well, the tax system strongly incentivizes me to go and set up. And I'm a rational economic actor. I'll follow the incentives. I'll make more money if I run a small business. Because even though I'm maybe less efficient at doing that, because I've now suddenly brought on in my role, not only doing the thing I'm really good at, but also doing the HR function, doing the ringing around to get the jobs, doing all of the accounts and all of those things, or having to find somebody to do all of those things for me one-on-one. The fact that I get a much lower tax rate makes it worth doing it. And as Resolution Foundation has shown in this area, that's been bad for growth. That's led to a kind of tale of, along with brilliant small businesses that we have, a tale of not so brilliant small businesses. They're actually not ever intended to be long-term growing businesses. They're intended to be one-man, one-woman bands of just a way in which I'll do my own work. So that's been bad for growth. It's also cost us in revenue because those are people who would otherwise have been working and paying a higher tax rate and are paying a lower tax rate. So fixing that would be good for growth and would raise revenue. At the same time, actually introducing an inflation allowance or some kind of investment allowance. It could be based on inflation, it could be based on the cost of borrowing, but either of those things would actually improve incentives to borrow because it wouldn't lead us in a situation where when interest rates go up, then suddenly it's not worth me borrowing to be able to invest in my brilliant idea because now I'm paying a tax just on the cost of borrowing as well as on everything else. By having an allowance against that, you'd actually say, if you've got a brilliant idea, it doesn't matter whether you're in a recession and borrowing is 1% or whether you're in a relatively better period or just a high inflation period and borrowing is at 5%. Either way, we're going to take that out of the tax base. So we would be supporting people who are making real investments while not encouraging this kind of shifting across different tax bases, which has been one of the things that's been bad for growth. So that's just one example. There are other examples of things we could do. But I think it would be worth just quickly touching on a couple of the objections that people typically have, just to say why I think these kinds of moves are sensible and why our standard objections are actually somewhat misguided. So the first objection is, well, everybody will leave. And it will be bad for growth because everybody's going to leave immediately. And this is a terrible idea. And clearly that's a kind of extreme version of the argument, but the idea is there'll be lots of mobility. There will certainly be some mobility. We have shown in our work that there will be some mobility if you increase taxes on wealthy people. Firstly, you shouldn't just take that as a given. That depends on the design of the policy. And currently, for example, capital gains tax is relatively easy to get out of. If you want to leave the country, you can leave, and as long as you spend 6 years, you can receive the capital gain as soon as you leave. And as long as you spend 6 years outside the country, you won't be taxed on that capital gain, even if you made it for over 30 years that you spent in the UK. None of that's taxable in the UK. So you could do things to try to reform the way that's taxed. The other thing from a growth standpoint is, how essential is this one person who's leaving, or these 10 people, 100 people, whatever number you think it is. It's worth remembering that most investment in the UK is coming from people who are not affected by things like personal taxes in the UK. There's a lot of investment from other countries. There's a lot of investment from pension funds, which you were just hearing about in the previous session. So those are things where the personal taxation bit isn't the question that's being asked. What the tax rate that's applicable is actually very different to that personal tax rate. So that's the first thing. But the second thing is you might still say, well, it's a concern that we do worry about those small business people, or maybe not so small, maybe medium-sized business people who are setting up companies and who will be affected by personal taxes. So I said, one of the things that's really important to understand about that group is that they aren't all immediately responsive to taxation. Taxation is clearly one of the decision-making features for them, but there are lots of other factors that go, and we've shown that across our work, both in quantitative work and qualitative work done by my team that's looked at what are the factors that are really important to them in their decision-making and where to live. On a personal side, their decision-making is heavily driven by also what does their life look like. You know, if you're well off enough, at some point you also care not just about where do you make the most money. You'll have quite a lot of money wherever you are. What you also care about is, you know, where can you send your kids to school? Where will be a nice place to go out in the evenings? Where is the rest of society kind of functional? Where am I not too worried about crime? Where can I get around fairly straightforwardly with the transport network that's there? And also from a business investment standpoint, where can I do business effectively? Where is it actually easy to do that? And those things are also factors. It's not just about tax. And so in a world in which we just think about tax in that decision making, we're not understanding how people make these decisions. So in terms of thinking about where the tax system is going in terms of wealth, you know, Sarah made a lot of points that are really important about the equity of the tax system and how we tax wealth versus work. That gap has been growing, and that is an important thing to tackle. But it's also worth understanding that our current taxation of wealth is actually really bad from an efficiency standpoint, from a growth standpoint. And given that we now have a government that says it's elected on a platform of trying to achieve growth and trying to improve growth, I think it's worth bearing in mind that tackling these challenges of taxing wealth better aren't antithetical to improving growth. Actually, in many cases, they'll go in the same direction as what you would want to do for the purposes of improving growth. And so I imagine that's some of the direction that we'll see over the coming months and years. Thanks.
Thank you very much. The increasing wealth taxes to promote growth. We get to hear, I should just say, by the way, that of course we are still active online as well on Slido, so our online participants who want to contribute questions do put in your questions on Slido. We're now going to hear from Martin Sandu, the European economics commentator at the Financial Times. Thank you very much for joining us, Martin. Over to you.
Thanks very much for having me, and greetings to everyone, including those who are joining us online. And thanks to my fellow panelists who have set out all the facts around this so well. So I'm going to take the liberty, since all the facts are now known, to make a normative argument. And I'll simply set out to you why I think a well-designed net wealth tax is a good tax, and the UK and other countries should do it, introduce one. I'm talking about the sort of tax that Sarah explained only a few countries in the world actually levy: Colombia, Norway, Switzerland, and Spain. Well-designed, of course, that word does quite a lot of work, and we will no doubt come to that in discussion. But I'd like to make 3 points. So a well-designed net wealth tax has a lot of good fairness arguments for it. It has a lot of good efficiency arguments for it. And I think it can take in quite a lot more revenue than the examples we have seen in practice that Sarah talked about. And that is an important factor given how hard-pressed public finances are, not just in this country, but in most advanced countries at the moment. What is a fair tax? Well, there's one principle that I think everyone accepts in some way in theory, and then we can disagree on how it applies in practice. But the greater your ability to contribute to the public finances or common expenses of your society, the greater the burden you should shoulder. Your net wealth, the excess of the value of assets you have over your liabilities, your debts, that is a measure of your ability to contribute, much like the size of your income is a measure of your ability to contribute. So just from a sort of first principle, why would we not want people with a lot of net wealth to contribute somewhat more than people with very little net wealth? So from a basic fairness point of view, a tax system that is fair should to some extent track net wealth. we could make arguments about how a larger share of public revenues should come from capital or wealth in general. The slide that you put up at the beginning, David, shows how the tax system hasn't really kept track of the increase of the importance of capital and assets in our economies, and this is true across advanced countries. But I'd like to be a bit more narrow and say that even if we don't want to talk about that balance, but even within capital taxation, the net wealth tax is fairer than many of the alternatives. You mentioned the council tax here, but we can make that point about property taxes in general. Property taxes in most countries are a gross wealth tax. That is to say, it's a tax on the gross value of your real estate wealth, not taking into account whatever other wealth you might have on the upside or whatever debt you might have on the downside. So a young couple that has bought a flat at £500,000 with a 90% loan-to-value mortgage, net wealth 50,000, will pay a significant amount in council tax or equivalent property taxes in other countries, whereas somebody who has 500,000 in the bank and no debts, so 500,000 net wealth, will pay nothing of that. I mean, that, if we just put it like that, it's clear that that's unfair, whatever else we think about it. So much for fairness. I think it's incontrovertible that there's some fairness argument for some of the tax system tracking net wealth. So I want to talk about efficiency, my second point. And again, we can talk about this in terms of capital taxation. Keep the overall capital taxation constant. I think that a net wealth tax is not just fairer, but also more efficient than some of the alternatives. I mean, I think it's very clear why it's more efficient than the council tax or property taxes because of that punitive element I just described. But let us compare the standard ways of taxing capital wealth, so capital gains tax, dividend taxes, and so on. The main difference between those and a tax on net wealth is that how much you pay in tax depends either on how much of a return you get versus how great your wealth is. So two people, both with $1 million in net wealth, under the standard system, how much they pay will depend on how much return they generate, which depends on how they invest that wealth. It'll be a tax on the return. In a net wealth system, you'll pay the same no matter what your return is, but you'll pay on the basis that you have $1 million there to do something with. Why do I say that the latter could be more efficient? Well, because if you think about it, if you have two people with $1 million, and think of the parable of the talents or something here, they invest it in different ways. One person has a 10% return. They may be a productive entrepreneur. Another buys a yacht that depreciates very fast. Well, you don't get much yacht for $1 million, but luxury car or something that depreciates very fast. In the standard system, you'll basically protect the bad capitalist, the person who makes the unproductive choice of how to invest their capital. Whereas you will tax more the person who invests their capital in a more productive way and gets a higher return as a result. With a net wealth tax, you actually let the more productive investor keep a much larger share of their return, whereas the bad capitalist, if you like, the unproductive investor, gets penalized for their unproductive choices. We're not talking about fairness here, just efficiency, but the economist in me wants to say, well, it's actually quite good for our economy to reward those who invest in high return users. And because you have to get the money from somewhere, you take more money then, relatively, from those who invest badly. If you combine that with a pretty high threshold before it kicks in, the net result of that sort of system will be to favor those who invest well and make it easier for people to build up their first sort of wealth. If you think about the council tax example, it's hard for people now to build up real estate wealth if they start from very little. And who pays for it? The ones who've got a lot of wealth, maybe heirs, whatever way they've got it, but don't invest it well. I think that's efficient. Another efficiency element, and here I think there'll be quite a lot of disagreement. I tend to think that a net wealth tax, if it's well designed, it's actually harder to avoid than some of the other ways of taxing wealth. Capital gains, dividend taxes, inheritance taxes have the feature that they're periodic, irregularly periodic. And to a large extent, when you are taxed on them depends on how you dispose of your wealth as a taxpayer. For example, which country you decide to live in the year you realize your capital gains, or when you think that it's time to leave this earth and hand things over to your heirs, or maybe when you pass a gift on. All of these things are within the choices of individuals, and given that we know governments change, tax rates change, the effect of the sort of adaptability you have to these taxes, I think, is much larger than a wealth tax that is levied every year, and maybe a new government will increase the rate a bit or lower it a bit, but you have to pay it every year anyway. So you don't have these opportunities to time things so that you get a large part of your wealth out of the tax net at the crucial moments. Final point. This can be a tax that yields significant amounts. So I'll share with you a sort of heuristic, a rule of thumb that when I worked on this for my last book, An Economics of Belonging. It just so happens that in most countries, the top 10% by wealth own about half of the national wealth. The US is an outlier here, it's about 70% there. In most countries, total private wealth is about 6-7 times GDP. In the US, it's actually a little bit less. So it turns out that if you consider the following net wealth tax, it is imposed on only the 10% wealthiest and only on the amount of their wealth above the amount that gets them into the 10%. Turns out that in pretty much every country, the tax base I've just described to you is about 2 times GDP. So if you manage to capture that base, if you manage to capture all of it, which means a well-designed, here's where well-designed comes in, you basically manage to tax that, a 1% tax rate on that will bring in 2% of GDP. Right? So 1% of GDP here is about 30 billion pounds. That's big money. So, even though it's much smaller than the big taxes that we usually talk about, it's significant money, right? So 1% wealth tax in an ideally designed way, 2% of GDP, a 2% wealth tax, 4% of GDP. So these are not small amounts at all. It's well worth thinking about and considering. Thank you very much.
Thank you. When we heard the furniture crashing, I thought it was someone heading to get onto their private jet and leave for Geneva straight away as we rev up.
They have a wealth tax.
Yes. So
it's the highest of all the cantons.
So where would you, let's follow up on that, where, just in terms of the design issues, there's a set of ideas from an overall, I think what Martin is describing is an overall wealth tax with an ingenious sort of cut-off for aiming at the people with the top percent of wealth. What has tended to happen is that we've ended up with a range of different taxes, often around events, because the classic Treasury view would be that trying to work out exactly how much people are worth is very tricky, but they die or they sell properties or they sell assets and enjoy a capital gain. So you end up with this slightly ramshackle structure around when particular things happen. And one thinks that there seems to be a sort of purist argument for a single wealth tax and a practical argument for lots of different ways of levying revenues on different activities. Can we just go through those type of options? And perhaps, Sarah, as you review them from the OECD perspective, we might start with you and then we'll hear from Aaron and Martin.
I think there are different questions. One is, do we want, should we consider a wealth tax to replace other taxes? And so it's the wealth versus taxing the income from wealth question, which I think you touched upon with the efficiency arguments, and there's a lot of literature at the moment coming out on this. And then there's the question, which I think is more sort of prevalent in the policy proposals, which is having a wealth tax targeted at really the ultra wealthy, in addition to, I don't think these proposals are saying we should get rid of CGT, we should get rid of inheritance tax or dividend taxation. So I think a lot of these proposals are actually in addition to it's just that a wealth tax in these kinds of proposals are really targeted at much higher levels of wealth. So I think this is a first important question. We don't, it's, there's wealth versus income taxation, and then there's just wealth taxation in addition to income taxation. And it seems like a lot of the debate is focused on that, on the latter. In terms of also, I think an important point is there is scope to use a wealth tax to address the limitations of existing taxes. I think I think it's important to fix existing tax instruments to make sure that they reach their objectives. Doesn't mean you can't think of additional tax policies, but I think there is a lot of scope, and so that's what I was, trying to show, is that we have a lot of taxes in OECD countries, and there are a lot of similarities in the sort of issues around the wealth-related taxes. And I think it's important to make sure that these taxes function better and that they function in the ways that they were initially intended to function, because you have taxes that were intended to be highly progressive that end up not being highly progressive because of tax design. And so I think, there is scope to reform existing taxes, and whether a wealth tax can be considered in addition to that is a discussion, but not necessarily as a replacement to reforms to make sure that we have properly functioning, capital gains taxes and inheritance taxes in countries that have that.
Martin, do you want to comment on that, and particularly how in your model, what your design would be?
Yeah, I mean, I think I agree with everything you said. We should make the current taxes work as well as they can. And then we may or may not part ways on whether in that system you would still want to introduce a net wealth tax. I think you should, for some of the reasons I set out. But I would step back first, because we need to see this in the bigger context. So the first question you want to ask is, what should the government's tax take be, right? How much do you need? Or what is the politically correct, not politically correct, the political choice for what imprint the government should have in the economy? And there'll be some number, right? And then you say, well, what's the best way of raising that? And then that will depend on which country you're talking about. France probably needs to tax less. Other countries, this country probably needs to tax more.
Yeah, I think that is an important way into it. If you start off just with the sense we hate wealthy people and we want to tax them more, that is less way win of the argument than saying for any given amount of tax that we need to collect in order to fund our welfare state, what's the right balance between that being a tax on earnings and work and a tax on capital? And if you get into it that way, you may have more permission to move, which of course was in a way the backdrop to what Nigel Lawson was trying to do in the 1980s. Aaron, do you want to comment on this? And there's also, I think there's a question which is probably particularly prompted by your intervention about worried about the disincentives to entrepreneurship and innovation with wealth taxes. You were arguing that partly because of the structure of British business, you would penalise professionally managed enterprises and reward people who set up on their own. This was inefficient. So do you want to also tackle that challenge?
Great. So just first picking up on this sort of maybe slight disagreement between Sarah and Martin, I'd say that certainly I think we're all in agreement that currently UK taxes on capital don't work very well and there are things that we'd all want to fix. Then in terms of the question of what role does a wealth tax, a net wealth tax, have on top of that, I should say that I, a few years ago now, co-led the Wealth Tax Commission in the UK, and just like picking up directly from our recommendations, the first one was, whatever you do, first fix existing taxes, because existing taxes on capital, the capital gains tax, inheritance tax, and so on, just aren't working very effectively, so to do that first. Our third recommendation was, if you care about wealth inequality, and we said very clearly, it was not for us to tell anyone whether they should care about wealth inequality, but if you care about wealth inequality at the very top end, that concentration of wealth, and or you think you want wealthy people specifically to pay more money, to contribute more to society, and again, it wasn't for us to decide if that's where the balance should be. If you want those things, the only way you can do that effectively is with an annual wealth tax. If you want an annual wealth tax, a sort of net wealth tax of the sort Martin has proposed, you need that to start at a high threshold. So I don't agree with Martin's sort of 10%, top 10% of the population. We said think of something like £10 million as the threshold. Why is that? That comes back to exactly the challenges that Sarah set out. Actually, if you want a wealth tax that functions, if you want to deal with the fact that we've observably looked at other countries and seen why those wealth taxes haven't raised a lot from the very wealthiest, they've raised a lot in some cases, but not from the very wealthiest. It's because if you have a large share of the population paying a wealth tax, you have to take shortcuts. You just physically can't value all the assets. And you have to worry about liquidity issues. Those issues are really different, as Sarah said, at the very top of the distribution. So if you're thinking about people above £10 million, then in the UK, that's sort of 22,000 people. We actually can go about and value their assets effectively. You can take market values. You can always, of course, say, well, we'll just take a shortcut. We can take the book value of their business. We can take all these kind of shortcut values. The problem with taking those shortcut values is those are exactly the things that have shown us in other countries that we will end up with gaps in the wealth tax for that group of people. They will find ways to reduce the bills. And so that's why it's really important. If we're going to have a wealth tax, if that was something you argued for, I think you can only really have it effectively at the very top. Then what does that do to entrepreneurship and innovation? I mean, I think then there comes back to this argument that Martin made. That is, there's actually a lot of debate now about how much that will sort of limit entrepreneurship versus spurring it. You know, saying actually you can't just have £10 million. I mean, the first £10 million is tax-free, but above that, you wouldn't just sit with that money, park it in a bank account, because you'd suddenly, at the market interest rate, not be getting a great rate that you're paying tax on. Maybe you want to go and try and invest it in more productive things. And so you have that incentive to take slightly larger investments, whether it's you doing it yourself or whether it's you going out there and having a fund manager do it for you, or some kind of family office, if you're further up the wealth distribution, who's managing that for you. But you'd have somebody out there thinking, well, actually, how can we best get a return on this? Because we know that, say, 1% is going to be taken away every year. And so we really have a strong incentive to try to find those investments that are productive. I mean, those forces can go in different directions, but I think it's certainly not clear that it's going to be terrible for entrepreneurship and innovation.
Right.
I mean, also one final point actually on that is that the other argument that people make in that entrepreneurship innovation thing is, well, why would I become a billionaire when I'm going to have this huge chunk of my money taken away? I have yet to meet anybody who is in the entrepreneurship space thinking about trying to grow a business who's concerned that in a world in which they were to make £1 billion, they're very sad they'd pay a 1% tax. They would all, I think, 100% take the trade-off that gets them to the £1 billion first. So I'm not very convinced that it's a disincentive to trying to build that business. That if I got there, I'd have that. But, you know.
This is the badge of honour argument. Okay, all right.
No, it's that when you get, a world in which you're a billionaire is a great world for you, given you start at, much less than that. And so you'd accept it at that point.
Okay. Martin?
Yeah, to follow up on that, it's, I think a lot will depend on what you think the motivations of budding entrepreneurs are. Do they have great ideas and want to commercialize them and get as rich as they can, given what the tax system is? I mean, I've spoken to startup people, and the fact that, as you said, that they will have to pay 10 million a year if they become a billionaire, that's not what discourages them. The liquidity argument is the best argument against. So if you are a startup business, you've got some capital injection that puts a paper value on your company at 50 million or whatever, but you don't actually have any cash because you've invested it all. It's quite difficult to then have to come up with the cash, especially if you are the sort of scrappy startup investor who's mortgaged the house and so on. So there needs to be, I want to say two things about that. One is, there are very few cases like that in sort of across the universe where you'd be applying a wealth tax. So there was a paper by Statistic Norway just a couple of years ago that looked at this because there's a big argument, political argument in Norway. This discourages entrepreneurs. They found that 99% of business entrepreneurs who paid the wealth tax, their wealth tax was less than 2.5% of their company's revenue. So, it's not a big deal for very many people. But there is a deal for a few people. And you have other situations of illiquidity, the widow sitting in a huge house that has huge market value but doesn't have much income. So you need a solution for those special illiquid cases. To me, it seems like the best solution would be an option to, instead of paying the tax in cash, you pay it, as it were, in terms of a claim the government has on the estate, and the day it is realized by sale or gift or inheritance, that's when the accumulated amount is taken out. I don't agree that the informational problems are significant at all, actually, not in this day and age. Wealth is, property we already value for property taxes. So you may do it well or badly. In Norway, it's a formulaic system. Financial wealth that's in listed companies, there's a market value. Valuable objects, cars, yachts, and so on, they're insured. You can require insurers to report the insurance value. So there's one difficult thing, which is privately held businesses that aren't traded,
which are 80%
which my liquidity solution would deal with, right?
How does the liquidity?
Well, you'll say, you don't pay the tax in cash. Instead of a 1% tax on your assessed wealth, we say, we get 1%. We have a claim on 1% of the company. They do realize it. or pass it on to your heirs.
So then you're taking 1% of every year, taking 1% of whatever the final value of the company is. So if it's worth not very much for 10 years, and it's worth a lot in the 11th year,
1% of whatever the current value is, 1% is 1%, right? You don't need to assess it in that case.
You do need to assess it every single year if you're on an annual tax, because you need to know what it's worth. If my company is worth £100,000 for 9 years and it's worth 10 million in the last year, if you're telling me you're taking away 10% of my £10 million on the basis of the fact that 9 years is much below that.
It was your choice not to pay earlier, right? If you really was if you were convinced of that, you'd take out a loan and pay.
No, but what's the value in those early years? What's the value in those? So say I want to pay it. I'll pay it year by year.
Nobody will be forced to take this option.
Yeah, so
if
how are you
they
going to
can document that the value is low, then that's fine.
So I guess the question is, how are you going to value it?
No, it's an option in addition to whatever the ordinary thing would be.
But how are you going to value it in those early years? That's ultimately the question. How do you want to value it in my company all of those years? If you're taking a threshold of the top 10% of the population and get the value of all of those companies, that is a lot of companies you're trying to value.
Well, most of the wealth we're talking about, most of the tax base, is actually property and listed finance.
But there are a lot of companies.
Right?
There are a lot of companies.
So these exist, I agree.
That does remind me of an exchange I had with George Osborne after he was Chancellor, talking to me about some of the work we were doing here on property taxes and actually housing and the taxation of housing and stamp duty. And he offered, and we at Resolution don't much like stamp duty because we see it as a penalty for transactions. And he offered the following rationale, which I did not recall him ever offering when he was the Chancellor. He said, look, he said, I agree there should be some kind of property tax at the rate of about 1% a year, I thought would be. And you will find, he said, that behind all the different rates we've now got for stamp duty, there is an average rate of 7%. And you'll also find, if you look at property transactions, you'll find on average people hold their house and sell it every 7 years. So I saw my stamp duty regime as an averaged out 1% a year property tax. I said, you never said that when you were Chancellor. But that was quite an ingenious attempt to get around this issue. And of course, it's only a general, it doesn't apply in individual cases, but that's how he sought it. I've got a question which I think, if I may say so, is a particular one for the OECD, which was, does there not need to be international cooperation on tax policy for ultra-high net worth? Doesn't it also require us to address our own tax havens? So tell us, give us an update on exactly where the OECD's work is on all this and how it ties into G20.
So the good news is there's already international cooperation that helps make taxation on high net worth and ultra high net worth individuals more effective. And that's the exchange of information between tax administrations. So there's international standards that ensure that there is information being exchanged on financial accounts between tax administrations, either on request or now on an automatic basis. So that means that tax administrations know what their taxpayers have offshore thanks to the exchange of information. And that's been really a game changer in terms of being able to tax capital effectively. So the good news is we're already, there's already international cooperation. The question is whether there needs to be more international cooperation. I think there is, some discussion in terms of trying to think whether there are certain assets that are not covered by the exchange of information between tax administrations, in particular real estate for the automatic exchange of information. So there are questions about whether the scope of the exchange of information between tax administrations should be expanded. There's also the question of whether there needs to be, cooperation to address other issues, in particular the mobility of individuals. And so there's literature showing, and Arun's written a paper about this, looking at mobility responses. What happens when you raise taxes? Do people leave? Is there a mobility response to taxation? And so you have some studies that show large responses, others not so much. But it is a threat, or it is a concern, a fear that governments have whenever they consider a potential increase in the taxation of high net worth individuals. So it is putting de facto a constraint on the ability of governments to raise taxes on high net worth individuals or to maintain them at a low level. And so I think this is an area that is worth looking into because it is a constraint for governments. Are these fears justified? Are these concerns justified, or are they overblown? This is something that we can look at. And then if these fears are justified, and perhaps there are factors today that make individuals more mobile, and this risk of tax-related migration being, you know, maybe in the future it might become more of an issue, who knows, but it's worth looking into. And also thinking about what are the policy tools that governments have. Is it, you know, can you deal with that domestically through an exit tax, for example? Or do you need some other form of more integrated international cooperation? And so those are all questions, but there are definitely questions that I think OECD, you know, some OECD countries are thinking about.
Right, thank you very much indeed. We're nearly getting to the end, but I just wanted to make sure, give the opportunity to have people physically with us in the session. If there's any of you want to ask a question on wealth taxes. Yes, one. We have a roving mic.
Thank you. Can you just give us the empirical evidence of total tax take from wealth where there has been tax, wealth tax implemented, particularly with Norway as an example, because I'm pretty convinced it's gone down, not up.
It's been pretty stable, actually.
Yeah, I think it's. I haven't looked at this in the last couple of years, but I don't think it's changed very much. I don't think it's. But it's relatively low amounts of revenues. I mean, Switzerland, I had it on the slide, is an exception because of how they design their wealth tax. It's a low, you know, I mean, it changes depending on the cantons, but there are a lot of people in the tax net. There are also a lot of wealthy people in Switzerland. But yeah, I don't know the response to how it's evolved in Norway. But there are concerns about mobility in Norway, that's for sure.
I looked up your OECD data before coming here, but they don't go up until, what is it, 2022?
Yeah, that's right.
The latest ones. So the Norwegian ones, it's about 0.5% of GDP. That's been stable up to, well, 2022. It is true that in the years since then, the tax rates, wealth tax rates have gone up. Some people, some very rich people have moved to Switzerland. That's been quite publicized. There have been a bunch of other changes too, including to the capital gains tax regime and when you get exempt from or you leave the capital gains tax regime after emigrating. It's very hard really to pin down what the, what the cause of the 100 or so very rich people who left might have been. And I don't think we have the numbers yet on how that affected. I mean, it's certainly in absolute numbers, the wealth tax take has gone up in the last 2 or 3 years, but GDP has gone up as well. So I don't know about the rate, but I'd be surprised if it had gone down.
And can I just clarify, and this is slightly springing the question on you, but if for our UK figures of capital taxes, broadly interpreting, collecting our revenues at about 3.5% of GDP, across the OECD, how does that look? And indeed, what are the kind of comparable figures of places such as Norway and Switzerland?
So one issue with the data that we have in the OECD is that, so I can't give you an overall figure of capital taxes, mainly because some countries don't distinguish personal income between labor and capital income. So I talked about Australia and Canada. They tax all income together. So we basically don't have a figure on average for labor versus capital income taxation. But from memory, if we look at separate, if we look at the council tax, I think the UK is among the countries that raise the highest level of revenue, at least as a share of their total tax stake in the OECD. I think you're number 1 or number 2 maybe. So it actually is a comparatively large revenue raiser in the UK compared to other OECD countries. For inheritance tax, I think you're pretty average. I mean, I don't remember you being anywhere near the top. But yeah, unfortunately, that's an issue with the way we have data on reverse capital.
Then one very quick intervention, then we'll bring things to an end. Yeah.
What would you say to a very experienced accountant who was a Labour MP for many years, who served as the Chief Secretary of the Treasury between 1964 and 1970, and then serves as the chair of the Royal Commission on the Distribution of Income and Wealth between 1974 and 1979. And when I asked him what he had done, he said, I spent 6 years trying to tax wealth, 6 years studying what I'd done, and I broadly concluded it was a waste of time.
Is that Joel Barnett?
Yeah. No. Jack Darmond.
Ah, right. Okay. Well, I think that is also... let's turn that into a slightly more specific question, because we are getting to an end, which is if Rachel Reeves or one of her advisors were here, and who knows who anonymous on our Q&A online might be, what do you think is doable in Britain as things are at the moment? Why don't we start with you, because you clearly already investigated this, Aaron.
Yeah, and so I think one answer to that earlier question, that very specific earlier question of what do we know 50 years ago versus what do we know now. I mean, when we looked at this at the Wealth Tax Commission in the context of specifically a wealth tax, one of the things we pointed out was the last time it had been studied in the UK was 50 years earlier, and the world had moved on quite a lot, both in terms of mobility, which is a new set of issues to think about, in terms of actually what information do we have. Sarah pointed out the fact that it's harder now, not impossible, but harder now to evade by holding money overseas because there's a lot more information sharing and there's work going towards increasing that information sharing. So there's still certainly things you could do, but the world is really a different place. So I think a lot of those things that were difficulties, and what we found at the Commission, but also thinking about not just an annual wealth tax, but about wealth taxes in general, was some of the constraints that we had 50 years ago actually have been loosened, and it's actually easier to do some of those things. The thing that has become sort of more difficult in a sense is that mobility in general is much higher. And so that touches on the earlier question of, well, what do we do about the fact that some people might move? It's still the case that there are lots of things that affect that decision, so it's not just about the tax rate. It does depend on what the lifestyle is that they will benefit from where they live. And I think the UK should be proud of the fact it offers a lot of things other than what it does in terms of its tax rate. But beyond that, I think, we also can think about the design of the tax system to account for those things. So in terms of what should Rachel Reeves' advisors be thinking about, they shouldn't just be thinking about what's the design of individual taxes. They should be thinking out, well, what are the effectively anti-avoidance provisions to some extent? And actually, how in general do we want to design a tax system that accounts for the fact that people generally are moving a lot more than they used to? How should we design that in a way that's fair for everybody, both those people coming in, but also those who want to leave independently of tax reasons, but who should naturally at some point step out of the net?
Right. Thank you. Martin, your advice?
Well, I'll echo the fact that the world has changed a lot, and I would focus on sort of our ability to process information. I mean, there clearly are some conceptual difficulties, in particular unlisted company wealth. But of course, any country that has an inheritance tax has to address that problem anyway, right? That's the same with the net wealth tax, recurrent net wealth tax. And it seems to me that informational issues, both because we share more, but because we can process and access and find information more easily, must be a lesser problem than it used to be. I think what went wrong, and it wasn't just the UK, I mean, there's a reason, as you pointed out, Sarah, that most countries that had net wealth taxes have abandoned them. I think, in addition to things being more difficult in the past, these wealth taxes were ill-designed in the sense that they did hit at a pretty low level, which means that politically it became necessary to give various exemptions or rebates or valuation discounts. So you created very messy systems that in the end became costlier and inefficient to run for the amount that they raised. But of course, Switzerland shows that it can be done. And you could start the tax at a higher threshold than the countries that do them now do. I mean, Switzerland starts at 20,000, some cantons, I think. Norway starts at about 150,000. My suggestion was 10%, which is what, 500,000-600,000 here, or even higher, right? The top 5%. I mean, then I think you're in a different kind of space. But in the end, it depends on politics, right? If your politics is sufficiently vulnerable to special interest pleading, then you will not have a good tax system. But that's true of all tax.
Right. Sarah, anything that OECD thinks about the regime as a whole across advanced economies?
I think the main message is, and I tried to show that in the introductory presentation, is if we do a sort of overview of how wealth-related taxes function, we see that there's clearly room to enhance the way these function. And so I think there's clearly scope for governments to look at introducing reforms. It's also, as I was saying in the introduction, I think there's a fairness question that will have to be considered by governments because most countries will have to raise more tax revenue. That's just a reality. And so this question of how, making sure that there's a fair sharing of the tax burden is something that many governments will have to grapple with. And then I'll just re-emphasize this point about the need for international cooperation and really recognizing that there is a cross-border dimension to taxing, in particular high net worth individuals, that needs to be carefully looked into.
Thank you very much. Thank you to Sarah, thank you to Aaron and Martin for a fascinating discussion. And this brings our whole day's conference to an end. We began by really trying to understand what had happened to the patterns of wealth ownership, and began with this year being the 10th anniversary of the Piketty work appearing in English translation. And we at Resolution continue to analyse this phenomenon and think about policy. We very much appreciate being able to do so in partnership with the Financial Fairness Trust. And we very much appreciate working with them and their support for this exercise. Thank you all very much indeed for attending, and also thank you to our participants online. That brings our conference to an end. Thank you very much.